City on this Monday, November 18th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills this morning. Let's get to the three things that you need to know today.
First up, U.S. stock futures fluctuating this morning after equities closed out their worst week in more than 2 months. Traders paring back Fed rate cut expectations, plus the S&P 500 now erasing more than half of its post-election gains. Wall Street strategists still see more room to run. Morgan Stanley's bear, Mike Wilson, seeing the S&P 500 ending next year around 6,500. Meantime, BMO's Brian Belski calling for humility in his 2025 outlook.
Plus, investors are awaiting earnings from chip giant Nvidia this week for the latest read on artificial intelligence demand, which has sent the stock up nearly 200% this year. Shares of the company taking a hit pre-market, a report by The Information that Nvidia has contacted suppliers about a chip design snag that's led to overheating.
That's right. Plus, Spirit Airlines has filed for bankruptcy. The budget carrier filing for Chapter 11 after its proposed merger with JetBlue failed to go through this year. Competition from larger airlines has weighed on the company as passengers found more affordable options on those carriers. The stock has fallen 93% this year amid those struggles.
Well, good morning and happy Monday to all. We've got a big week ahead. We'll finally get the earnings that we've all been waiting for. The bellwether, Nvidia, of course, the poster child for the AI trade. You're seeing shares pre-market on this Monday lower. As of right now, there are a few other big reports that, of course, are going to come up. But it's really Nvidia that takes up so much of the attention because of the fact that it's driven this theme that the market has piled into. And the markets have a larger question of what that longevity looks like from here. It's going to be interesting to see exactly what this $3 trillion market cap company has to say later this week.
It's a big one in terms of market cap on the S&P 500 and why it's one to watch. Taking a look at the options market pricing heading into this earnings print from Nvidia, the stock has moved about 9% on average following earnings previously. That's according to Citigroup. Options traders, this is typical for a number here around Nvidia earnings. Options traders pricing in about a 12% move to either side following these Nvidia earnings. And remember that this is a stock that has already doubled over the past year, tripled the year prior because of those GPUs powering the AI rally. So will we continue to see that demand moving forward here, Brad?
Yeah, 100%. It's going to come down to what they have to say about the future of the data center as well. One of the more interesting things that we've heard kind of quarter over quarter here is about how companies are going to need to power the data center of the future. The amount of chips that are going to be necessary in that data center for all of the inferencing technology and the AI stories that are annexed to that inferencing technology. Well, for Nvidia, they've been able to tell the markets exactly what the markets have wanted to hear, but a lot of larger questions around whether or not for Jensen Huang and the rest of the crew over at Nvidia, if there is more in terms of the purchase orders that investors can start to price in, because now we're trying to figure out what exactly that baseline is for recurring annual orders and recurring annual revenue that we can expect from the growth that they've seen this far. The growth that they've seen is, as our own Dan Halley was talking about, it's tough to top when you're saying one quarter, hey, we've seen 200% growth, or hey, we've seen 150% growth. At some point, you face some tough comps in that growth, and that's, I think, what investors are really trying to wrap their minds around too.
Right, even if the growth story is continuing, it's been going down over the past 6 quarters. The deceleration, there you go, Brad, thank you. So will that deceleration already be priced into this earnings print, or will we see some pain on the other side? That is, of course, the big question here. Now, Nvidia has risen almost 200% just this year, and it's been responsible for about a quarter of the S&P 500's total gains. So how will the company's earnings impact the broader market? Joining us now to discuss, we've got Tom Essay. He is the Sevens Report founder and president. Tom, it's great to have you on this morning. Talk to me about the single biggest thing that you are going to be watching out for heading into this print this week.
Good morning, guys. Thank you so much for having me on. With Nvidia, we can all expect them to produce sort of, I think, mind-blowing earnings. But really what the market is focused on is that growth rate. So the earnings beats for Nvidia have been getting smaller in each successive quarter. So they're still beating the number, but they're beating it by less and less and less. And if that continues to decline, if we get, say, a small single-digit earnings beat on the report this week, I think the market will be a bit disappointed by that. And it's all about the guidance. How enthusiastic and how aggressive are they on the guidance? It's all, it's a growth story here. We all know it. It's the future. It's the next big thing. They've got to keep us excited about it via this earnings print.
Tom, when you think about the visibility that people want to hear and investors want to hear from Nvidia leadership about what they're seeing in their own business-to-business contracts, the relationships that are going to bring them some of these larger purchase orders, and then their ability to work through some of that backlog as well. What do you need to hear to signal that there are several quarters more worth of purchase orders that still have yet to be unlocked?
Yeah, I think you hit the nail on the head. It's all about that just sort of enormous demand, right? Really what investors want to see out of this is that this demand for AI computing power sort of spreading across industries, right? We're going to have the major cloud companies are going to be the largest purchasers, your Microsoft, things like that. But the bigger issue is do they see any slowdown from their user end base, right? Because for AI to be the story that we all, I think, believe and hope it will be, it's got to spread through the economy to where we have companies using it that you wouldn't think are traditional sort of tech-heavy users. It's early in this sort of evolution to see that fully, but we can get hints of it through the demand picture from Nvidia, and I think that's another thing that investors will be looking for this week.
How much is the rest of the market really relying on Nvidia here? I saw a stat this morning that ex-Mag 7, the S&P 500's profit growth, is still hitting at about 2%. Does this market need an Nvidia win in order to get some of the S&P price targets that we've seen come out here over the weekend?
Yes. Now look, Nvidia is not the full market driver that it was, say, earlier in the summer when it was sort of driving the bus, as we say. There's other things going on in the market. But right now, we didn't trade very well last week, and we've given back most of these post-election gains. And we're sort of, there's some Trumpian chaos is sort of descending on the market a little bit, like it does from time to time. Investors want something to get excited about, right? It's close to the year end. Everybody wants the rally to continue. A good Nvidia print with strong demand, strong guidance would really give a nice positive, and I think would reinvigorate a rally.
I mean, what we were talking about earlier, Tom, a 200% run-up that we've seen just 2024. I mean, is Nvidia still the name that investors should be getting the most excited about, or are there other areas within the market that perhaps have more growth opportunity that investors can unlock better returns?
I think Nvidia is still the 800-pound gorilla in the AI space. They're the first mover. They have a huge advantage. Sure, everybody else is trying to build chips, but they're the first mover, right? They seem to have this market. So I think that's the bellwether. As they go, AI sentiment goes, and to a point, tech goes as well.
Tom, let's talk about what's driving the stock down this morning. It's off just nearly down 2% ahead of the market open here. Nvidia asking suppliers to change their server racks to accommodate for the Blackwell chips that are overheating here. They haven't said that would cause a delay in the Blackwell chip announcement. What do you make of the pressure on the stock heading into earnings? Does that set Nvidia up better for a pop, or could this news actually be bad news for Nvidia?
So I think some of it is sort of just pre-earnings selling, right? I mean, we always kind of see this, especially on very well-performing stocks. You see people kind of taking some money off the table into the uncertainty around the print. I think what you're seeing with some of the overheating is, at the end of the day, the stock is still very much priced for perfection, right? And I mean, we can quibble about, okay, maybe it's not on the high ticks or whatever. But look, as you said, this huge gain in 2024, the market is pricing it for perfection. It is not priced for some sort of a production oops, right? And that's going to be kind of the challenge for Nvidia. Yeah, the market is demanding very strong guidance, but they have to fulfill on the back end too, right? And the longer this sort of AI progression occurs, the more people are going to sort of shift their view and say, look, Nvidia has to execute on their manufacturing as well. So look, they've got a tough sort of tightrope to walk, but they've done it successfully so far. I think they can do it again.
Tom Essay, founder and president of the Sevens Report. Tom, good to speak with you here pre-market. Appreciate it.
Thank you.
A slew of retail earnings also on tap this week. You've got Target, you've got Walmart, TJX, Ross, and Gap all set to report. Joining us now, let's bring in Jessica Ramirez, who is the Jane Halley and Associates Senior Research Analyst. Great to have you here with us this morning. Which retailer, in your view, needs to outperform the most to impress investors as we head into a critical selling season and holiday season?
Yeah, good morning, and thank you for having me. I mean, from everyone that's reporting this week, I think it's a tough one, but overall, I feel Target will be much on the look. They had improvements, sequential improvements in Q2 when they did report, so I think they will be looking for a similar story with that. I mean, you also have Walmart, who has been performing very well, and they have been taking market share, particularly from the dollar stores and others. So I think that's also one key one to watch. And also just the comeback of Gap.
It's really interesting to watch Walmart because they've diversified the business so much. I wonder from your perspective, Jessica, is Walmart still this bellwether in the retail space given that diversification?
It is, it's been very interesting, and they just continue to evolve their business on all fronts. So you have Marketplace, where they've continued to invest and really make it omni-channel for the entire retailer. So do you buy something in Marketplace and can pick it up in a store, or can you return it in the store? So therefore you're driving more traffic, as well as driving traffic online. And the very exciting story I think that most have enjoyed to listen about is their media arm and how well that has performed. And again, there's a lot of data with these media arms that Walmart has it, Target has it, Ulta has it, and they're able to understand more about the consumer as they invest also with the brands and it's a nice ecosystem that they create. So again, I think that's really been helpful as well to Walmart, just the way they manage the business.
What do you think the state of the consumer is right now going into this holiday season? I mean, we've continued to hear value hacking, looking for deals, looking for discounts, and how is that going to translate through to the outlooks that we hear from these companies?
Yeah, so I think that's really what we want to listen out for this week and the coming weeks, where we have more of the retail earnings. So if we think about it, low-income consumer and middle-income consumer continue to be pressured. As we go into the holiday season, they have been spacing out the way that they buy in order to make sure that they have their gifts for the holiday season. And because we've had the pressure from inflation throughout the year, and from late last year, it has started to really take on savings of consumers. So it's still very tough. And when they are spending, they're spending in a very strategic way, which we've continued to say throughout the year. In doing so, yes, there is a value point, and that could be a price, or it's also, is this product something that I need now? And does it make sense for me to purchase it in this point? And is it actually quality? And if it is quality, they might pay the extra for it. But again, that might be taking away from something else. So again, very laser focused shopping, I would say. And I do feel that will continue into the new year.
And continuing on that point that Brad brought up, we know that Walmart is already starting these Black Friday deals. It feels like this one day has turned into an entire month from where I sit. Is that a positive or a negative signal for these retailers? And what can you tell us about what the appetite is looking like for some of those deals this month?
Yeah, so in terms of this month, what has been a bit of a concern that we're starting to raise. So just the background, the entire year we've had promotions. They've been very strategic. They haven't been very high. Even last month when we had Amazon Prime Day deals and Walmart and Target, it was still discounts of 20%, 30% off, nothing crazy. In this month, I've seen the discounts come up. Now, there is a factor that we had a lot of brands and retailers pull forward inventory. So when we've done inventory shops across the board, inventory has been quite high. So therefore, if you have too much inventory, you may need to cycle that a bit quicker. So promotions are very helpful in that sense. The other thing to consider is that the weather has been warmer. So I am seeing a lot of outerwear product to come down into promotions this month. And again, when we look at our proprietary data, we have had more 50, 60 discounts come in the last week than we did last year. So again, it's going to be a balancing act in how we see that. But there is an issue of how quickly can we cycle through all this inventory that came in very early. As I said, throughout any of the retailers that we've gone through in person, we have seen quite high inventory levels.
Jessica, you're spot on. It has been warmer. I haven't even had to pull up the full depth and breadth of my hoodie collection from the cellar just yet here. All these things considered, what is the pass-through on promotions then and the impact on some of the earnings that you're going to be watching?
Well, in terms of, and again, it'll come down to guidance and how the retailers are seeing holiday go into Q4 and also how we view Q1 for 2025. And in terms of promotions, if the consumer is shopping those promotions, will they be able to balance that act? Will we still have great margins? Because retail in the past 2 years, we've had margins that we haven't seen in a very long time. I mean, I have some retailers out there with an 80% margin. It's unheard of. So how does that work? And I think we haven't seen a lot of growth in particular with retail, but we have seen very substantial businesses that have been running on all cylinders, which has been a positive to a lot of the investor community.
All right, for our stock pickers out there listening, look for those 80% margins. Seems like a good time to get into those stocks. Jessica, thank you so much for joining us. Really appreciate it.
Thank you.
Jessica Ramirez is with Jane Halley and Associates as their senior research analyst. Coming up here on the morning brief, we're going to count you down to the opening bell on Wall Street as stocks looking for direction after a sell-off last week. Plus, we bring you the latest on Spirit Airlines as the low-cost carrier files for bankruptcy. And we get a look at Bitcoin as the digital token tops $90,000 again, though it's moving to the downside ahead of the market open here. We're going to discuss those moves and more on Morning Brief.
It's now time for some of today's trending tickers. You can track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Spirit Airlines officially filing for bankruptcy protection following a failed merger and mounting losses for the budget carrier. Spirit expects to be delisted from the New York Stock Exchange as a result of the filing here. Now, the airline says it will continue to operate as it restructures debt here. You're taking a look at shares. Yes, they are down 5% pre-market. Of note within this, they've received commitments for basically equity investments from existing bondholders. This is basically going to be some of the bridge, but ultimately for shareholders out there, you're going to see kind of nothing as of this juncture. You're going to have to wait until all of the bankruptcy proceedings to go forward and then hope that you can eventually get some of that money back.
And I think this is a really important kind of case study. I know I bring this up every time with Spirit, but this is what happens when regulation potentially leads to bad news for the market. This is a company with 13,000 employees that are now going to be out of work if the company does in fact die in the throes of this Chapter 11 bankruptcy. And that's not necessarily what the FTC wanted. They wanted to keep low-cost carriers alive. So at what point do you have to allow for some deal making in order to keep those low-cost carriers available to consumers who've now just lost one of those options when they're looking at those flight prices on Expedia or whatever you're going to look on now? They don't have a Spirit carrier to look at.
Yeah, we're going to dive into this more on wealth in terms of the consumer angle, but for those who are watching and do have a flight either on Spirit today, tomorrow, or in the future, they did note that you can still use all tickets, credits, loyalty points as normal, continue to benefit from the loyalty program, and then the team members are still going to be trying to give an elevated experience to whatever extent that means. And looks like, especially as this bridge is going to help them stay in operation, but there are still more questions about reemergence from bankruptcy as well. They're actually expecting the process to complete in the first quarter of 2025 here. So that is some interesting context to this all too, and the anticipation for what Spirit and the executive leadership team is hoping for. As of this point.
But really good point, though. You can still use your tickets. So great point to bring that out for our consumers listening here, Brad. All right, well, next up, Tesla rising as the Trump transition team says they plan to ease rules for self-driving cars, reportedly making a federal framework for the technology a top priority for the Department of Transportation. You can see those shares up 6% here. I was using our new Yahoo Finance comp tool to take a look at Tesla compared to some of the other stocks on the street. Of course, I pulled up Nvidia, and it was really interesting taking a look at Nvidia's price to earnings. I think it was about in the 60 range. Tesla still above 90. So this is still a very expensive stock, and it's just going to keep getting more expensive as we get this news tied to policy that lifts this stock. This idea of full self-driving technology getting streamlined through regulatory pressures and kind of getting an immediate checkpoint on it is certainly lifting the stock this morning, Brian.
I like the comparison that you brought up here, which is Tesla versus Nvidia, because of the mindset that if you're looking at this next wave of Tesla being more than an automotive entity and being more than a power company, it's an AI play for a lot of the investors out there, the most bullish investors that have been looking what exactly full self-driving means for this broader AI narrative that Tesla is trying to draw here and trying to prove to the market as well here. They mentioned within the most recent earnings call, a lot of our viewers will remember that they continue to expand the AI training capacity to accommodate the needs of full self-driving. And ultimately, how that plays out in the future is having to make sure that you have not just two states that you're able to roll this out in.
Yeah.
Right now, primarily California, Texas. They're expecting, at least Elon Musk, according to the call, is expecting that they're going to get approval next year in California and Tejas, and towards the Bay Area, branch out beyond those two states as well.
And if it really doesn't work, it won't get fast-tracked, right? Like it won't be available if it truly doesn't work. There will be regulatory pushback. We do have some of those checks and balances in place. We don't have as big of a margin in office as some members of the Trump administration would have liked. So there is still potential for a long road ahead on this regulatory approval.
Absolutely. All right, let's talk a little Netflix here. NFLX, we got the ticker. Let's fire it up. And for those of you who are still buffering from Friday's big event that took place, Netflix announcing 60 million households tuned in for the boxing match between Jake Paul and Mike Tyson over the weekend. Yahoo Finance's Alexandra Canal, never buffering. She joins us now in studio with more on the record-breaking event.
Yeah, 60 million. I mean, that's quite a number here. Netflix had been teasing this event for a few months now. They're obviously very proud of it. And if you were on social media over the weekend, this was an event that really dominated the headlines, dominated social media. It was this true water cooler moment at a time where we don't really get a lot of those anymore with the streaming, binging model, really taking over live television. This was one event that really showed that sports-driven content is fueling this type of viewership. Now, that being said, the actual broadcast was a bit of a mess. You couldn't really, some folks weren't able to access the content. It was, like you were saying, teasing the buffering issues, some technical glitches. On-air guests couldn't really hear their cues, and there was some confusion over the types of hosts, and that's leading to some pressure on shares this morning. We're down about 1% in pre-market trading because if Netflix continues to lean on live events, they really need to get it right. They can't keep having these technical issues. We have the upcoming doubleheader NFL Christmas Day games. Certainly the NFL doesn't want any types of those issues. CBS is the producing partner there, so the hope is that they'll kind of be able to help Netflix. But this isn't the first time that they've seen some of these technical issues, and it really feeds into the flywheel of the advertising tier. Netflix said that they have 70 million monthly active users. That doesn't mean 70 million people are paying for the ad tier, because that could include multiple users having the same account. But still, it's a number that has been steadily rising. We know that this is an important driver when it comes to Netflix's future earnings growth, future revenue growth. And again, it's that ecosystem of content that you need to make sure that you're getting right. So live events, continuously important. This event, no exception, but they do need to fix these technical glitches.
Will that CBS partnership be enough for the Beyonce concert that I hear has a sideline of some football going on?
Yeah, I mean, hopefully it is. Yeah, Beyonce is headlining this Christmas Day game. Huge. It's the first time Cowboy Carter is going to be performed live. Beyonce obviously has a very close relationship with the NFL. She's performed at multiple Super Bowls, also has a close relationship with Netflix. And this is really exciting for all those Beyonce fans. I love Cowboy Carter, so I'm very excited to hear her, to see her. But yes, if there's any technical glitches during Beyonce,
yes, that's the thing.
Like, there can't be any buffering issues.
More confident that they will get the tech figured out, right?
Yes. And you think about the sheer number of people that are going to be tuning into this.
Yeah.
I'm very curious to see the numbers, and if we do see any of those glitches, what that could mean.
As an Eagles fan, it might be the only time that I wear a cowboy hat while watching an NFL game.
I know, I agree with that, Brad. I agree.
All right, guys. Well, thank you, Ali, as always, for joining us. Really appreciate you bringing us your reporting on that. We're going to have all your markets action ahead right here on Yahoo Finance, so stick around for more. You're watching Morning Brief.
Welcome back. We're taking a look at the U.S. futures here for the major averages. You've got the Dow flat barely to the downside here by about 0.1%. S&P 500 futures flat barely to the upside there, 0.06%. And then you've also got the NASDAQ right now holding on to gains. The futures pointing higher by about 0.3%. We'll see exactly where things open up just seconds from now as the opening bell on Wall Street and in Midtown Manhattan at the NASDAQ are set to ring. As we're taking a look at your screen, you've got the great folks from Axalta, the coating systems company that you may know from Glen Mills, Pennsylvania, down the street from where I grew up in Westchester. They're ringing the opening bell at the NYSE. And then you've got some funfetti with Fortinet over at the NASDAQ, ringing the opening bell, kicking off a big week. We've got earnings, of course, coming in hot from Nvidia, Walmart, Pinduoduo, PDD, Lowe's, and Target. Just a few of the companies, the big names that are going to be reporting over the course of this week. Let's do a quick check of the markets. We're officially open for trade here in the U.S. Taking a look at the Dow Jones Industrial Average, we are lower by about 0.1%. NASDAQ Composite, though, higher by about 0.1% as of right now. We were taking a look at fractional gains going into the opening cross. That's just what we have here at the start of trade. The S&P 500 flat, just barely to the upside here. Let's populate this chart for you just so that you can take a quick look at exactly how things have been trading. We'll give you a year-to-date. Why not? It's a new week. Let's give a reminder of what we've been doing coming into this. And of course, a little bit of a pullback that we saw tail end last week. We'll see exactly where things kind of play out as we're seeing some hyper waffling, oscillating between gains and losses to start off today's session. But year to date, still good. Let's also take a look at the 11 S&P 500 sectors. We've got them loaded up here for you on your screen so you don't have to do any work. Take a look. We've got consumer discretionary, consumer discretionary. That's up by about 0.9% to start the day. But bringing up the caboose, real estate, XLRE, it's down by about 0.4%. We're roughly split, about as split as you could get for 11 sectors here. Looks like more gainers than decliners, but that is flipping as well. So with more on today's opening trade, let's get to Yahoo Finance's Jared Blickery for a look at what's moving.
Thank you, Brad. I want to go back to that S&P 500 chart you were just showing, and we'll dial that up on the Wi-Fi interactive behind me. This is year to date, and what I want to point out is that the S&P 500 came back to the election breakout level, and it is just testing that. And I'll dial this down to a 2-month chart so you can see. I'll put some candlesticks so you can see in more detail, but there's a level right there. Violated a little bit to the downside, but importantly, we're off of the lows, and you want to see this level hold. Otherwise, this could be a false breakout. That's something that suckers in traders. Just something we're looking out for. Not confirmed yet. We're still in confirmed uptrends on most time frames here. In fact, I would say all time frames. Also want to take a look at the VIX, which is rising. It's jumping a little bit off of support levels, pretty low levels. And I'm going to dial up a year to date so you can see, kind of hard to see with all those candlesticks and also that big spike. But basically, we've been coming down to this territory before and bouncing off. And so it looks like we're just getting a little bit of liftoff of support. And as a reminder, when we get the higher VIX, that tends to see equities roll over. So just kind of combine that with the potential for a false breakout. And you see what I'm saying there. We already did the sector action with Brad, so I want to take a look at what's going on in biotech. This has been really challenging to navigate. First, we had an election breakout, and then we just suckered in all those new longs to the downside. And this is a pretty steep decline, one of the biggest that we've seen since the pandemic. So that is what I'm focusing on here. And then finally, I just want to point out that gold is having its best day in several months. And I'll show you a 3-month chart on that. It is also bouncing off of support, kind of like the VIX, but totally different market. And I'll send it back to you guys.
All right, Jared, a great reminder that policy impacts the trade still when we take a look at that biotech chart there. Thank you so much, Jared Blickery, for joining us. It's time now for today's strategy session. The U.S. stock rally slowing as investors debate the Fed's path of interest rates. But what do the technicals tell us about where the stock rally stands? Joining us now to discuss, we've got Adam Turnquist, LPL Financial's Chief Technical Strategist. Adam, it's great to speak with you. So I just want to start pretty broad here because we are seeing that post-election rally giving back nearly over half of its gains. What do the technicals tell us about what's coming next for this rally?
Hey, good morning. Thanks for having me on. I don't think investors should be too surprised we're giving up some gains here. We were very overbought coming into what we call overhead resistance marked by the upper end of this longer-term rising price channel, the S&P 500, has been for this bull market. Internally, we saw about a quarter of the S&P 500 get overbought as well. So we're taking some profits here, pulling back. I think the key level we're watching in today's session, 58.60, 58.65, that's the price gap coming out of that post-election rally. If we start filling that gap, that goes to a failed breakout and does open the door for some further downside. But longer term, the trend is still up here. Breadth still very bullish with cyclical leadership. So I think it does set up for a potential buy the dip.
You know, as we're thinking about this, I'm taking a look at a note from the UBS that's in my inbox right now, and just talking about and addressing some of the gains that were given up last week, but also the headline that they're sending was redeploy excess cash. If investors are trying to look across and kind of cut through some of the noise of the opening bell here this morning and some of the first trades that have fired off and trying to initiate their own strategy, even despite this pullback, where are the areas that they would be apt to look at and set more long-term positions?
For longer term, we like the industrial sector as one idea. It's been one of our overweight sectors for this year. That has pulled back as well, still trending higher. I know there's some concern over defense spending and cuts in that area, but I think overall, when you look at the themes playing out in the industrial sector, you have some leverage to AI with the data center buildouts, that reshoring, nearshoring theme as well. Those should be some pretty good tailwinds for the sector. We like it on the earnings front. The fundamentals look good. Technicals also look good, and we're seeing some relative outperformance there.
I know you also, in your recent notes, talked about the small caps rally being a bit overdone. Do you see opportunity then in mid caps for investors who want to look beyond those large cap names?
It's hard to compete with the big caps right now. And even at the mid cap level, they do look a little bit better than small caps. And there's been a lot of excitement post-election about small caps. Are they finally going to start outperforming? The answer technically is no. They've had fits and starts of this excitement and outperformance that have been really suffocated by the large cap leadership that seems to be reasserting itself. Of course, we'll see how that plays out this week with Nvidia kicking off earnings on Wednesday. That's going to be a big driver, I think, of that large cap growth trade working or not working.
With all of this in mind, I mean, I'm taking a look at some of your own analysis of the post-election day S&P 500 performance and it being a good sign for future returns. Typically, how long does that stay within the tape, stay within some of the mindset of investors? How much kind of longevity even to that fervor have we typically seen? And when does the market then turn its head to, okay, this actually is starting to matter more? And is that just once we finally see the changing of the guards and policies start to emerge?
I think it's going to come down to policy and when that does emerge. There's a lot of uncertainty. We've heard a lot about the rhetoric coming into January with President-elect Trump, what he's going to do when that gets instated and how, I think is going to be a big driver of volatility or potential upside for the market. Of course, the market gets ahead of itself sometimes, especially on a shorter term basis. And I think that maybe is what we've witnessed here just over the last couple of weeks with this rally.
Well, given that in your note, Adam, I think you put it really well, that the macro does tend to outweigh some of the policy and personnel decisions coming from DC. Having said that, though, Powell last week said, okay, we may not have to cut as quickly. Is a hard landing underpriced? And what are the technicals telling us about that?
It doesn't sound like it when you hear Chair Powell the last two presentations. He was pretty bold up on the economy, talking really about growth. That's been the big driver of interest rates moving higher. Not so much inflation, of course, that's a byproduct of growth, or not so much the threat of tariffs. He really painted a pretty rosy picture for the economy for a Fed official, of course. In terms of the rest of the growth story, I think that's going to come down to how we can handle this interest rate move. We're now talking about a 10-year near 450. I don't know if the hard landing is completely out of the story, but it seems to be more, at least the market, drifting toward a no landing scenario where we have pretty robust growth, maybe a little bit higher inflation than we want, and unfortunately still higher for longer interest rates.
Adam Turnquist, I can't wait for the day where we don't have to talk about hard landing, soft landing, no landing, and just find a new analogy. Eventually.
I'm with you, Brad.
Thanks so much for the time, Adam. LPL Financial Chief Technical Strategist. Good to see you this morning. Coming up, everyone, we're taking a closer look at the crypto community and the crypto space as the post-election Bitcoin rally It's cooled a little bit, but it's still up today, sitting at about $90,000. Stay tuned. President Trump continues to fill out his cabinet, but as of this morning, one crucial position is still undecided: his Treasury Secretary. According to a report from the New York Times, Trump is even expected to bring in new candidates for the position this week. Here to break down the field and what's at stake with that decision, we've got Yahoo Finance's own Ben Werschkoll. Ben, you've been analyzing and also putting some pen to paper on exactly what these candidates could look like. What do you know?
Yeah, it's getting less clear by the day, amazingly enough. So as you mentioned, Donald Trump is expected to have two new candidates in the mix, and he's expected to meet with them at Mar-a-Lago at Florida this week. The first one is former Fed Governor Kevin Warsh, who was sort of seen as more of a Fed candidate and was on shortlist last time with Trump. The other is Apollo Global Management CEO Mark Rowan. Of course, Yahoo Finance is owned by Apollo Global Management. And this comes in addition to the two other candidates you see on your screen there last week. Scott Bessent, who's the Key Square founder, and Howard Lutnick, the Cantor Fitzgerald CEO. And sort of these are the four candidates that you see in the mix. They're kind of going up and down by the day. And the issue here seems to be that Trump is trying to get a candidate who can do two things that maybe are irreconcilable. One is to be cheered by the markets. He wants somebody that when he announces it, the markets go up and they're happy to see it. He also needs somebody that can kind of credibly sell his tariffs, which the markets obviously are a little less keen on. So what you've seen in the last few weeks are some of these candidates trying to kind of beef up their tariff bona fides, even if they said more critical things in the past, to kind of try to be the candidate for Trump on these two issues there. So not a lot of certainty at the moment. With more meetings expected this week, we might be waiting a few more days, but the only certainty, I guess, is sort of more uncertainty for a little bit.
It's interesting, Ben, and a note from Peter Cheer over the weekend, he sort of pulled this metaphor that either Trump is picking people based on 3D chess or 52 card pickup. Basically, is this tactical right. or is this just off of vibes? And I know that you did a lot of reporting, speaking with folks about kind of the thinking behind this decision. What does that leave you with in terms of your thinking on what's driving Trump's decision here?
I think most of the people around the process are kind of as sort of speculating as much as anyone else is right now, because it can kind of go these two different directions you mentioned. Matt Gaetz last week is an example that, based on the reporting around that, happened on a plane flight that was 2 hours that no one saw coming. So this is a process that could be kind of the 52 card pickup idea. Others would be this the 5D chess idea here too. I mean, I do think Trump is incredibly focused on the markets and economic stability, so he really wants somebody that can kind of be a face of his administration to try and do that. So he might be a little bit more considerate with that, but we'll see. He's sort of clearly unhappy with his choices at the moment.
Right, that's a really good point too. He wouldn't be searching for this long if he was very clear and bullish on one particular candidate. Ben,
exactly.
Thank you so much as always for joining us. Really appreciate it. Well, Bitcoin is trading above 90,000 this morning. The cryptocurrency spiking as high as $93,000 following the election of Donald Trump. The rally has since cooled off slightly, but the perception of Trump as a crypto-friendly president has fueled broader confidence in the sector. Here with more, we've got Rick Edelman, Digital Assets Council of Financial Professionals, founder and author of The Truth About Crypto. Rick, it's great to speak with you. We were just talking about the importance of the Treasury Secretary pick. To what extent do you think this Bitcoin rally could be dependent on who ends up being that top name for Trump?
Good morning, Madison. Good to be with you. You're exactly correct. If Trump doesn't deliver on the promise that he has laid out, then you will see this crypto rally become a crypto rout. There is no question that Bitcoin's incredible rise since the election is all because everybody's excited that Donald Trump is such a strong crypto supporter. He made it very clear during the campaign that he'll do everything possible to foster and develop Bitcoin and broader digital assets. If he doesn't deliver on that by appointing a pro-crypto Treasury Secretary and a pro-crypto SEC chair, then you're going to see this rally end as fast as it started.
Which is different from the stance that he took on crypto during the first time he was in office. So as we're thinking about what needs to shift as well in the broader tenor from Washington, D.C. as a whole, because it sounds like there is more acceptability to crypto that has come forward, whether that be either from a come to Jesus moment or because of a real swaying of realizing that, okay, we need to ultimately put this out there and a messaging out there to engage with voters. One way or the other, crypto is going to figure out a way to innovate, and the broader community is going to figure out a way to innovate and add more value in. So what are the actual policies that could be enacted that would add more value to the asset as a holding? And even as we've gotten off of the utilization, make sure that there's still opportunities for crypto to still be some sort of utilized currency as well.
Brad, you're exactly right. Whether or not the policies are favorable, crypto will do just fine. It's a global asset that trades 24/7. The United States cannot kill it. It can hinder it. It can slow it down, and that's proof by what you've seen under the Biden administration and Gary Gensler at the SEC. But if the administration is favorable and Congress is favorable, what you're going to see is legislative clarity. We have had a situation where Gary Gensler and the FDIC and other federal agencies have impeded the ability of banks to engage in crypto. They can't custody crypto. They aren't able to even open bank accounts for crypto companies. This has been a real challenge for the crypto industry to do business if it isn't able to engage with the banking community. So new laws and regulations that make it clear that banks are allowed to engage will basically open the doors and eliminate the obstacles and inhibitions that have been pervasive over the past 5 years. So that's what the crypto community is expecting. They're looking for legislation and regulation that provides clarity from a tax perspective, a custody perspective, a regulatory perspective that allows institutional investors and most importantly the banking industry to participate as freely as everybody else.
Rick, we started with a lot of the risks to this rally, but what is your base case for where Bitcoin is going?
My base case is that the Trump administration is going to deliver on the promises. The president will honor his expectations that he's laid out for everybody, and we're going to see Bitcoin over 100,000 by the end of this year, only in the next month or so. By the end of 2025, I expect Bitcoin to be north of 150,000, and by 2030, Bitcoin will be more than 420,000. That's a 5x roughly increase from today's pricing.
As we think about the amount of investing and the flows into crypto that you're anticipating we could see, what does that look like relative to, past emergences from crypto winters, if you will?
Yeah, the flows will be astonishing. As exciting as Bitcoin's rise has been since its inception, we really haven't seen anything yet because we largely haven't seen institutional engagement. Most Fortune 500 companies are not engaged. Most hedge funds are not yet engaged. Most endowments and pension funds are not yet engaged. Family offices, sovereign wealth funds. We are going to see an incredible increase of engagement. And even if it's a low single-digit asset, in the portfolio, that will represent hundreds of billions of dollars of new money flowing into Bitcoin. And because the supply is fixed, any increase in demand has to translate to a price increase. And that's why I and many others are expecting to see six-figure, and some are even arguing for seven-figure Bitcoin prices within the next 10 years.
Rick Edelman, founder of the Digital Assets Council of Financial Professionals. Great to have you here with us. Good to catch up, Rick.
Thanks, Brad.
All your markets action straight ahead. Stay tuned. You're watching the Morning Brief. Welcome back. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. So let's go. Supermicrocomputer facing a deadline to file a delayed 10K report, or at least submit a plan to file said form to the NASDAQ in order to avoid being delisted. The company failed to file this report with the SEC over the weekend. Their deadline Monday, today, and ultimately investors right now sending shares higher, perhaps on some optimism that they will file some type of plan in order to avert being delisted from the NASDAQ.
All right, another one we're taking a look at today. T-Mobile is among a number of telecom systems hacked by Chinese intelligence agency. That's according to the Wall Street Journal. Now, this was reportedly parts of a months-long campaign to spy on cell phone companies. It's unclear what information was taken. We do know, however, this was not necessarily a cyber attack focused on a slew of individuals. It was targeting what they called high-value individuals, particularly those in politics. The FBI is looking into any potential broader impact here, Brad.
And finally, we've got Samsung unveiling a $7 billion buyback plan over the next year. Analysts note that the buyback was a surprise, and it could be a catalyst for the stock. Shares are down more than 20% this year. However, here this morning, you're seeing shares up by about 6%. This is also going into what's going to be a big season for some of the smartphone market, where Samsung is one of the largest by market share, at least within that realm. So we'll see how that performs too.
All right, well, that does it this morning for the Morning Brief. You can join me and Brad in the next hour for more analysis on catalysts. So stick around for more. Welcome to Catalyst. I'm Madison Mills alongside Brad Smith today. We are 30 minutes into the U.S. trading day. Let's get to the three catalysts that we're watching this hour.
First up, we push ahead to Nvidia's results as investors await the biggest of the Magnificent Seven stocks to report earnings.
And we get a look at the contenders for Treasury Secretary as new names emerge for the chief economic role.
And also, we're going to hone in on Elon Musk as the billionaire escalates his feud with OpenAI and Microsoft. All that and much more coming up on Catalysts.
Nvidia shares are lower ahead of its earnings out Thursday. A report from the information saying its new Blackwell AI chips are overheating in its servers. That's weighing on the stock this morning, down just about 2.5%. So will Nvidia's results live up to the high expectations and turn this current stock move around? Joining us to discuss, we've got Paul Meeks. He's the portfolio manager at Independent Solutions Wealth Management. Paul, it's always great to chat with you here. What are you expecting heading into this earnings print? Is the current pressure on Nvidia's stock something that sets them up better for a pop after those results?
Yeah, I think they're going to have a nice beat, but here's the problem, Madison, and I got this data from the analysis tab on Yahoo Finance. 4 quarters ago, the company beat the street's EPS estimate by 19%. Next quarter is 11% beat. Then it goes down to a 10% beat. And then the last quarter was, quote unquote, only a 6% beat. So a lot is expected of Nvidia, and they're going to have to beat the estimates by even more. Let's get back to a double-digit percentage increase beat. And then I think people will feel more comfortable. In the meantime, today's issue about potential overheating in the Blackwell chip, it's obviously not a positive. We also don't know it to be true. And you may recall a couple weeks or months ago, there were similar kind of manufacturing glitch issues, and that actually brought a good opportunity to buy the shares. Right. And so if this stock backs down to the 50-day moving average price of about 130, I'd probably buy it with both hands. As to the quarter they're going to announce Wednesday evening, I think it's going to be great. But as I said before, it's got to be a bigger beat than they have been beating the last few quarters. I need to see that. In the meantime, I have a third of my portfolio in this stock, and I feel good about that.
Paul, what are you expecting to hear on the demand pipeline front?
Oh, I think the demand's going to be very, very bullish. And that's no surprise, Brad. You think about all of the other companies or customers in this AI GPU supply chain have been raising their CapEx guide, have been very bullish about their own demand. And so I think that is not in question that we will have a very bullish demand picture. And that's why I think, Brad, that if we do have a short-term manufacturing glitch, because nobody else is as close as they are to making these chips, you buy it because the demand is there and they'll fix their problems.
But it's interesting, we've still seen 6 quarters of growth deceleration in the stock, Paul. At what point is there something that stops the momentum for Nvidia? Is it that lack of further growth as a catalyst, or is it something potentially more insidious like a competitor coming in?
I don't think it's really going to be a competitor. I do expect AMD to get its act together and be a viable second source, but it's also interesting that in the last couple of days, AMD announced that they're firing 1,000 people, which is pretty large, 4% of the global workforce. So we do know that that company's problems are more CPU related, but still, I don't think that they're going to close the gap. So it'll be a big market. AMD will have a slice of that pie. Nvidia will continue to have the biggest slice of the pie. And what would happen is, and the greatest tell would be, when you start to get the capital expenditure budgets from the hyperscalers, the guys that are building these big data centers, and they start to rein in their CapEx. In the last couple of quarters, they've been increasing their CapEx. That'll be the tell to look for.
At what point would we be able to tell, and investors out there really be able to discern when Nvidia's shifted from a valuation front-running position to then growing into a valuation, and how does that kind of show up in some of the metrics that we hear on a quarterly basis, at least at this juncture?
Yeah, well, what I tell you, Brad, is I know most people say, okay, the stock tripled last year. It's working on a triple this year, so it must be overvalued. But if you take a look at it, it's trading at 30 some odd times next year's earnings, and that's probably a relevant growth rate for the next couple of years. So it's trading at about PEG parity. I actually look for stocks trading at that range as tech values, or at least relative values. So I don't think we have a problem with valuation. I actually think valuation can expand. But again, it's all going to be about, oh my goodness, the hyperscalers have reined in their capital expenditure budgets, and that's going to back into less demand for NVIDIA's GPUs.
Paul Meeks, always a great opportunity to get some time with you. Thanks so much for teeing up what we're all going to be sitting on the edge of our ergonomic chairs waiting for, which is those NVIDIA earnings later on this week. Appreciate it.
Be well, guys.
You too. Let's turn now to take a look at the broader market. Stocks mixed to start the week. Post-election rally cooling. Could NVIDIA's earnings be the next catalyst? That is the big question. Joining us now in studio, we've got Chris Wadling, who is the CEO and Chief Market Strategist over at Longview Economics. Good to have you here with us. Founder at Longview as well, we should note. So as you're kind of breaking down what will exactly the markets kind of latch onto this week, of course, it's always been the earnings bellwether that has been NVIDIA, but what do we need to hear from NVIDIA to really impress or continue to give more of a rally on mindset for the markets here?
Yeah. Great question on NVIDIA. I mean, obviously, I'm not a stock analyst, but we spend a lot of time thinking about the Mag 7 and NVIDIA and all these kind of stocks. What I find fascinating is that when I was last year in August, I was suggesting the market's moving away from the Mag 7. And actually, if you look at a lot of these stocks, they have moved away from them. And we're kind of down to Mag 1 or 2 now, and NVIDIA's the big one. So of course everyone's obsessed with earnings this week, absolutely. But I think you made the right point. The earnings growth momentum is slowing. It's not as fast as it was. And when you look at stocks like this in the stock market, you look at the second derivative. It's the rate of earnings growth, if you see what I mean, that really matters. So I think that'll be the focus. You look around the semiconductor sector, quite a few stocks are really struggling. It's not all, so it's getting harder. The sort of focus is narrowing in on not much left in terms of semis and tech driving this market higher. Personally, I'm more interested in the dollar. I'm more interested in 10-year bond yields. I'm interested in the macro data. I want to hear if China's actually going to do some more fiscal stimulus. These are, to me, this market is rotating into cyclical stuff. Small, mid caps, global. Next year is going to be great global growth, as long as we don't get too many tariffs too quickly. So all of that, I think, is really quite encouraging.
Well, let's talk about that global growth. You have fiscal expansion in a lot of countries, Germany, for example. How is that global growth combined with what we're seeing in treasuries going to potentially impact what we're seeing in equities? Could there become a tipping point where you see some pressure in equities? Yeah,
there's a risk of a tipping point. Personally, I don't buy that. I think bonds are really attractive here. They've backed up really hard. Yields backed up really hard. They've sold off on price. And everyone's bearish bonds now. And the narrative always becomes gloomy when things have moved a lot. They were talking about the Minsky moment in bonds and how we're going to pay for all this fiscal stuff. That's always the way. The narrative follows the price. But actually, if you look at the price, people are bearish. It's oversold. And actually, we need lower bond yields to get this economy re-accelerating. There's a lot of parts of the US economy that haven't done much for 2 years. People have kind of forgotten about that. We've all been focused on a bit of fiscal and a bit of Nvidia and so on.
What parts haven't? It feels like it's been all growth. Consumer spending, all-time highs.
Housing is in a depression in terms of activity. There's been no manufacturing employment growth for 2 years. There's lots of bits of people, middle and lower income and so on. So there's lots of pieces of the economy aren't quite firing.
And so is the consumer as resilient then as we're expected to believe, or at least is showing up in some of the economic data, especially when we look at retail sales? And I get it, certain categories have been lagging for sure, but there still seems like there's a tenor for the consumer where, if possible, they're going to spend.
Yeah, look, I mean, I think rate cuts that are coming through and will keep coming through. By the way, almost every time the Fed's cut rates, bond yields have gone down, not up.
Right.
Okay, so, this is all good news. I honestly think the economy will do well next year as long as we keep getting the rate cuts and the whole yield curve comes down. And as you say, there's fiscal stimulus in China, probably a bit in Germany, in the UK, and probably in the US. This is rate cutting everywhere, stimulus everywhere. All of this is good. And I think the consumer, really, if you look at the US consumer, they've been retrenching for 15 years. So they're in good shape.
Two things I've been obsessed with this morning: the lack of a Treasury pick from the Trump administration, the incoming Trump administration, and then also this range offered by Morgan Stanley for the S&P next year from 6,400 from 4,600 to 7,400. You could drive a truck through that range, right?
What is that? That's their forecast. Is that a forecast?
So then where do you find conviction then? And is the Treasury pick sort of the elephant in the room that's leading to a lack of conviction, or is it something else?
Well, it's very interesting you say that, because, of course, the way tariffs are implemented is the big risk out there. And I suppose, to be fair to Morgan Stanley, if tariffs all come on day one, right, maybe you do get a lot of downside, at least in the first half. But getting beyond that, I think, and the Treasury pick probably is part of that equation, obviously the trade pick as well. So I don't know. I can't read the guy's mind.
Where do you find conviction then?
Well, I'm pretty convinced that the global economy is going to be really good next year, and I'm hopeful that tariffs are going to be a negotiating tool more than just bang. I like small and mid caps in the US. We like Spain. I know it sounds a bit random, but actually it's a very interesting place to put money. It's doing very well. There's 4 countries in the world in the major stock markets which are growing earnings much faster than the States and which are valued at less than 50% valuation of the US. So money's all been one way for a long time now. Yeah. It's all been into the US. It's all been into the Mag 7. It's all been one direction. I think that's changing as we go into 2025 and 2026.
You mentioned stimulus efforts in China earlier. What is the likelihood that we see stimulus efforts or at least overlap with the same time that we might see a tit-for-tat tariff and trade war pop up?
It's quite likely, because it's one of their tools in China, isn't it, to offset the tariff tit-for-tat. So, look, I think the good news in a way is Trump isn't completely new to the international community. Everyone's had a go before, so they know how to strategize and play the game to a degree. So hopefully there'll be some measured tit-for-tat rather than aggressive tit-for-tat. But yes, more stimulus is coming out of China.
Real quick, before Spain, you mentioned you like small and mid caps. Do you like the indices, or are you stock picking?
Well, I think consumer cyclical is going to have a good 12, 18 months. So, but and more sort of and cyclicals geared to the economy, housing stuff maybe.
Sure.
But yeah, I'm an index guy, so right. Yeah.
Of course. All right. Well, Chris, thank you so much. Great points, as always, across the board. Really appreciate you joining us this morning. Chris Watling, he is Longview Economics founder, CEO, and chief market strategist. Let's take a look at some market headlines to kick off our hour, sponsored by Tasty Trade. Let's take a look at the major averages here. You can see some pressure still. You've got the Dow moving it to the downside here. You've got the S&P off just below the flat line there, and you've got the NASDAQ up about 0.3%. Let's flip the board over to Treasuries so I can take a look at what's going on in the bond market here. If we do have those Treasuries for now, thank you guys. We are still seeing moves to the upside when it comes to yields, though not a huge degree of movement. That 10-year still off of that 4.5% that we saw it hitting after the election rally. And finally, I want to take a look at Bitcoin moving around that 90,000 level this morning. We saw it tipping just below that 90,000 level and then tipping to the upside. So we'll see if we can get you that live Bitcoin number coming up here. Now, later in our show, we're going to look at today's trending tickers. We're going to give you the news behind the moves. That's coming up next right here on Catalysts. Let's get to some of today's trending tickers. You can track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page by scanning the QR code on your screen here. Now, first up, we've got MicroStrategy buying $4.6 billion worth of Bitcoin over the last week. That is the largest purchase by the crypto hedge fund since it started buying the digital currency more than 4 years ago. Now holds more than $29 billion in Bitcoin, making it one of the wealthiest corporations when it comes to financial assets, larger than the cash and marketable securities of global market leaders, including IBM, Nike, and Johnson & Johnson. That's according to data compiled here by Bloomberg. Only about a dozen S&P 500 members hold more financial assets, which is pretty remarkable given that you've got some of the biggest banks in the world on there. You've also got some of the biggest companies when it comes to big tech. A company like MicroStrategy outpacing the likes of IBM, which is considered kind of the old responsible AI guy in the room. That's a pretty significant bump up for this company. And as we always like to remember here, we had Michael Saylor on and asked him about buying Bitcoin, and he said, I'm going to be buying highs on Bitcoin forever. And that's exactly what they did here, Brad.
Yeah, it's a Bitcoin company that just so happens to have been started as a business solutions and kind of business intelligence software company that has now made a firm pivot, at least in the narrative and the story, and it's been compelling for shareholders who are looking at MicroStrategy and saying, this company holds so much Bitcoin on its balance sheet. A investment in MicroStrategy is essentially an investment in Bitcoin at this juncture because the two are so annexed because of its holdings and how much it's continued to dollar cost average into its additional add-ons of its stockpile of Bitcoin. All these things considered, there are a few new catalysts that this company is also going to be watching for, and some of it comes back to the conversation that we were having with Rick Edelman during the 9 a.m. hour here today about what is next and the expectations that you get a pro-crypto SEC person that is appointed in the Treasury as well as the SEC. That is going to potentially push Bitcoin to $100,000 by the end of 2024. That's the projection from Rick Edelman, who we had on, and even Michael Saylor. He said he would be surprised in a few interviews he's been doing that whether or not crypto actually does this, but he would be surprised if it does not hit $100,000 by the end of 2024. And it sounds like he's ready to tee up a big party if it does.
That Treasury pick is going to be really critical here, to Rick's point, and it's great that you bring that up. This idea that we've got this 100K priced in. What happens if Trump doesn't pick the right person when it comes to the crypto community? That'll be key to watch for sure.
Absolutely. Another one that we're watching here today, we've got CVS adding 4 new members to its board. This is part of a deal with activist investor Glenview Capital. Glenview's CEO will join the board, along with 3 other directors, bringing the board total to 16 members. There you're taking a look at shares, up by about 3.7%. Of course, in some of the larger activist campaigns that we've seen come about, Glenview certainly has made it known some of the changes that they would like to see come through. And of course, as with any activist campaign, they feel like those changes are more likely if they put their people on the board and have a little bit more say in the direction.
Well, it's interesting because Glenview had already accumulated a stake of about $700 million in the company. So they already had a seat at the table. They just wanted to make it as official as possible, it seems here. It's interesting to think about the context of where CVS has been. Guys, I want to see if we can pull up the year-to-date chart for CVS from the control room here, because the reason I point to this is that CVS has withdrawn its guidance for the year, offering investors no outlook amid the broader struggles for CVS, which really paints to this picture here of how much CVS has been struggling. Over the past year to date, it's down over 30%, Brad.
Yeah, the company's saying as we build momentum across our integrated model, they continue to take some actions positive for long-term success, driving innovation, performance in the individual businesses and at CVS Health overall. That coming from the CEO and president, David Joyner of CVS Health, and adding these 4 experienced thought leaders, they say, to their board further sharpens the focus on executing against that strategy and hopefully improving, at the end of the day, the total cost of care for customers too.
Certainly. They got a lot of health experience on this board now. The question is whether or not it's a company that can be saved by the healthcare side of the business. All right, well, coming up here, Trump narrowing down his search for that Treasury Secretary position. We're going to take a look at Washington policy and the impact it could have on the market next. President-elect Trump reportedly interviewing 2 additional candidates for Treasury Secretary at Mar-a-Lago today. Those people, Kevin Warsh, former Federal Reserve Governor, also Mark Rowan, CEO of Apollo Global Management. Reminder, Apollo is the parent company of Yahoo Finance. Meantime, Trump ally Elon Musk shared his support for Howard Lutnick. He is the billionaire co-chair of Trump's transition team. That's just the latest that we've heard from Trump and the members he's considering for his cabinet. For more on what's to come with the decision, we've got Isaac Boltansky. He is BTIG Director of Policy Research. Isaac, always great to speak with you. A lot of big names, a lot of headshots on our full screen there. Talk to us about what is going to be the key thing that determines who is selected for Treasury Secretary.
You know, look, I think what we've seen over the past few days is Bessent was the clear front runner, and I think he has been fading pretty quickly here. The Elon Musk commentary over the weekend, I think, was noteworthy. But we've also got to remember that is just a historical matter. President Trump doesn't like this sort of public infighting from his folks. And so I think just conceptually where I'm headed now is I think they're actively looking for a third candidate here. And I would add to that list Senator Haggerty from Tennessee. He's a name that you keep hearing here in town. And so, look, I hope by the end of the week we know who the Treasury Secretary nominee is. I think that person is going to probably be easily confirmed if it's one of the folks we've been talking about. But what I keep reminding clients of, whoever this person is not going to be deciding policy on the big ticket items like tariffs, like immigration policy. All of that's still coming out of the Oval Office. This is still going to be a presidency that is driven by what Trump wants and when Trump wants it.
Isaac, correct me here, but it seems like the market still wants Bessent. That's certainly what I've heard from sources over the past couple of days here. If he doesn't pick Scott, what does that signal about how sensitive Trump is going to be to the whims of the market over the next 4 years? And is he going to be less sensitive to that than he was in his first time in the White House?
Yeah, look, I think that this is a fair framing. And if we have Bessent as the pick, I think that it's going to reinforce what many of us, including myself, believe, which is that the market is ultimately going to be a governor on some of Trump's policy moves. And it could be a replay of what we saw previously was the Trump administration viewing itself as a, quote, mark-to-market administration and really tying itself to the performance of the stock market. And so that's what Bessent tells us. If it's Lutnick, I think that the market needs to prepare for, I think, a more aggressive pushing on the tariff side of the story, and perhaps not as much interest in near-term volatility in markets. That's how the framing comes out for me. In between there is everyone else. And one of the reasons that I keep mentioning Senator Haggerty's name is I think that he fits kind of perfectly in between those two poles.
A lot of picks to this point for appointments have really kind of elicited reactions to just say, and almost sounded just like good punchlines to jokes. At this juncture, is it clear who's emerging as the adult in the room to really have the ear of President-elect Trump that could guide business policy and give a lot of CEOs something to at least negotiate with or have some type of inclination to know how this next Trump presidency might govern itself?
Yeah, look, I think we're all hanging on every word from Elon Musk. I think that he is seen as the tip of the spear there. I think there are also some who focus on the comments of, for example, Larry Kudlow. I think that he still has the presidency here. But, you know, all of this is really just reminding ourselves of history. And if you go back to Trump 1, there was no singular voice, right? Mnuchin had the presidency here, but so did Larry Kudlow. So did other business advisors, business experts in the community. It's always been advice by committee. And that's the way that I think that this administration is going to run as well. I know that there is concern at how the Treasury Secretary pick work has gone so far, but I think it underscores how important Trump views the business community, the economic issues that are ahead of us, and there's a reason that it's taking so long.
Do you think Bessent's out, Isaac?
No, I just think he's gone from the favorite to now just in the pack with everyone else. I think that the comments from Elon Musk are incredibly important. And I think that they're representative not just of Elon's viewpoint, but that of a lot of those in Trump world, that Bessent is a Wall Street veteran and someone who is going to be acutely focused on the views of the street and the investor community.
One of the massive things that was a theme for our Yahoo Finance Invest Summit, among a lot of guests, Mark Rowan being included within that lineup, was the type of deregulation that we could see come forward. How do you think that the position, even though Treasury Secretary doesn't have anything to do with that, it still has the attention of the president, still has a lot of conversations with the president and a mindset to understand what that deregulation could mean more broadly for policy? How are you anticipating what deregulation could look like under the incoming Trump administration?
Thank you for this question, because this is so important, right? Like, we all love playing the parlor game of who's going to be this nominee and will they get through? And of course, all of that's fun, right? It's high drama. But the fact is, the deregulatory agenda is happening no matter who is sitting at the Treasury Department. I can say with the utmost confidence that you're going to see bank deregulation. I can say with the utmost confidence that you're going to see a more supportive environment for crypto. I can say with absolute confidence that you're going to see a rollback of certain energy regulations. All of these things are happening no matter who the individuals are at the top of the agencies, because you have seen the change, the forthcoming change at the White House. And so there's so many investable themes here that I think you can have high confidence in, no matter who these picks are.
And is that good?
I mean, it depends how far they go. It depends how quickly they're implemented. So obviously there's some caveats there, but I think some of this is good. I think that looking at bank regulations holistically is something that we're in dire need of. I follow the Dodd-Frank Act and how it was implemented over the past 15 years, and we don't think about that as holistically as we should. It's become a bit of a Frankenstein's monster. I think someone looking at that from top to bottom is good. I think rethinking the future of Fannie and Freddie, who have been in conservatorship for 16 years, I think that's good. I think that, of course, reasonable minds can disagree on other parts of the economy, but at least within financial services, yes, I do think that is net positive.
Isaac, good to get some insights as always. Isaac Boltanski, BTIG Director of Policy Research. Thanks so much. Trump is reportedly considering scrapping the electric vehicle tax credit. Under the Inflation Reduction Act, taxpayers who purchase a clean energy vehicle in 2023 or later can qualify for a tax write-off of up to $7,500. The Zero Emission Transportation Association, a group representing EV and battery makers, said in a statement, quote, "If the United States is going to actually compete to win against China, there needs to be a demand signal aligned with that goal. Otherwise, we would be undercutting those investments and hurting American job growth." Joining us now, we've got Albert Gore III, who is the Executive Director of the Zero Emission Transportation Association. Thanks so much for taking the time here. Just the net impact, do you think there could be from removing this vehicle tax credit?
Well, thank you so much for having me. Zeta represents the full EV supply chain. So not just EV OEMs, but mining companies, battery manufacturers, all the way through to the electricity sector. And I think, the first impact would be to increase costs for consumers. And I think that's something that, is an area where we're fully aligned with the goals of this administration to bring inflation down. We're talking about American-made cars. Primarily, 3 out of 4 EVs sold in the United States last year were made in the United States. And that's been a result of this powerful demand signal. Also, 3 out of 5 EVs on the market today are available for below $45,000 before the tax credit. So ultimately, these policies are working to lower costs for consumers and bring jobs to the United States.
So what then is the biggest risk here, Albert? And I ask because I spoke with Tom Steyer at our Yahoo Finance Invest conference about this last week, and he said a potential big risk is that we see other countries like China pushing ahead of the U.S. when it comes to targeting emissions more effectively, for example. Is that something that you think could potentially push the Trump administration to offer more of these credits, given how he has viewed foreign competition in the past?
Well, I think that one of the goals of the incoming administration is to convince companies to bring jobs to the United States. And that's a goal that we certainly share. If we're talking about outcompeting China for manufacturing jobs in the battery and EV supply chain, I think we need to have a strong demand signal that sends the message all the way up through these supply chains that they need to be investing in the United States. That's been happening. Over $177 billion have been invested in our sector to build factories and to train workers. Georgia is a great example, $27 billion in e-mobility investments in Georgia. Savannah has a $9 billion EV manufacturing plant. This is foreign direct investment in the United States to hire American workers, build cars here, and we want to see more of that. I think undercutting that demand signal that is so tailored to U.S. manufacturing jobs all the way up the supply chain. It has requirements for battery components to be made here, for minerals to be produced and refined here or among our allies. I think it's a really important investment in the U.S. manufacturing economy, and we just want to emphasize that and ensure that that message is coming across clear.
To what extent would you qualify full self-driving as a demand signal for electric vehicles?
Well, I think full self-driving is a really important part of the future, and primarily these vehicles have been electric. It's a great use case for electric vehicles. It's very easy to build these into the grid. I was in Phoenix and surrounded by Waymos that were, driving perfectly next to me on the road. I think that that's going to be a really important part of the future, and ensuring that those vehicles are made here as well is really important.
All right, Albert, we got to leave it there. Really appreciate you joining us this morning. Thank you so much. Albert Gore III, Zero Emission Transportation Association's Executive Director. Thanks.
Thank you so much for having me.
Coming up, with Elon Musk heading to the White House, or at least circling it with the efficiency department, could this be a boon for the space sector? We're going to discuss that next right here on Catalyst. Elon Musk's SpaceX reportedly launching a tender offer in December that could value the company at $250 billion. That's according to Reuters. Joining us now to discuss the outlook for the space sector, we've got Andrew Chanin. He is the co-founder and CEO of Procure AM. That is the firm behind the Procure Space ETF with the ticker UFO. It's great to have you on here. Andrew, I want to start with your forecast for SpaceX, particularly given what we know about Elon Musk, his schedule getting busier with this Department of Efficiency. Do you think that's a headwind for SpaceX?
It's tough to say. SpaceX is an incredibly important company for not just the U.S. space economy, but for the global space economy, and what they've been able to do to dramatically lower the cost of accessing space over the last decade has been nothing short of incredible. And to the extent that the company is able to continue to deliver on its various goals, as well as being able to lower the cost of accessing space, that could have tremendous knock-on effects for not just SpaceX, but for other companies in this area, companies looking to send products to space to help further expand their businesses, and for the potential of human spaceflight as well. And so seeing the various goals that the government has, like with the Artemis program and how important SpaceX is, it's important to know that regardless of where the leadership may be politically, that the company is able to continue to deliver on its various goals and missions.
And part of those goals, I mean, reusable rockets, yeah, great, awesome, in fact. But then we think about some of the communication services that they're also looking to try and make sure that they can monetize. How soon does that start to get baked into the performance for this company, knowing that, yeah, they don't have to report quarterly at the same cadence as some of the other communications companies, but no doubt that is one of the larger plays into this valuation that they're achieving too.
Absolutely, and valuations tend to typically matter most when they're looking to do a new round of financing, and so that always brings to attention what the estimated value of the company is. But like you said, Starlink, being their communications entity, is something that they've teased in the future about potentially spinning that off if they want to raise more money into their other business lines in the future. And we haven't heard them necessarily walk that back. They've also talked about not necessarily going public with SpaceX ever, or not until they reach Mars. And we know now that the goal is to send rockets to Mars in about 2 years, with the other goal of sending humans to Mars potentially in 4 years. Those are certainly very aggressive forecasts, but at the same time, SpaceX has been a company that's been able to deliver on many of their promises over the years. So I certainly would be excited to see those timelines hit, but knowing how difficult space can be, it's not necessarily a guarantee. But Starlink has been delivering for customers around the world, both individuals as well as entities, whether that be institutions and companies, or governments and secure communications and for military purposes potentially. And so Starlink has been a booming part of that business, and one that they're certainly very proud of as becoming a pretty dominant force in the overall communications market.
Just a follow up to that, what is the likelihood then that you would put on a Starlink spinoff, and that being the way that the equity markets finally see at least a piece of SpaceX come public?
So I'm not allowed to make predictions on things like that, unfortunately. Certainly, I would be excited to see investors be able to have the ability to get access to SpaceX or its various entities within. And to the extent that that became a spinoff, that's something that our index would be able to potentially look at for inclusion upon there being a publicly traded vehicle out there for accessing SpaceX. But I'm not even able to guarantee one way or another whether or not it would qualify until all the various metrics are put out there for the public markets to determine.
Okay, so we'll temper some of the excitement there. One other story that we're watching this morning is senators calling for a probe on Elon Musk after reports of his contact with Russia regarding SpaceX contracts specifically. And at the same time, you have this SpaceX rival that's raising funds in Europe. Do you see an opportunity there for investors who maybe think that Europe could start to hold the ball when it comes to space and innovation, as Elon Musk is busy with government and potentially facing his own regulatory pressures?
I would greatly encourage seeing other allied nations to the U.S. take big leaps forward for their overall space industries. Certainly the ESA, the European space team out there, that's putting together The various European goals have many similar goals to its U.S. and other counterparts. So far, the ESA has been a bit slower moving compared to what we've been able to see over here in the U.S. and in some other countries like China and India and Russia and things that they've been putting forward. But we just certainly love to see more competition and more companies and more ingenuity come out around the world. Just looking at the company TEC and their next project, what they're working on, it's something that's far behind where SpaceX already is, and they look to be able to have a dragging competitor come out by 2028. That's something that SpaceX has already talked about is going to be a much smaller part of their business, in 6 to 8 years, and something that Starship is looking to significantly replace as well to be their big kind of cash cow in the future, beyond even what Starlink's capable of. So it's great to see that Europe is understanding that. At the same time, this is also opening up opportunities for other launch companies. So to the extent that a company or a government doesn't want to be beholden to SpaceX at all, there are other companies like one of the top holdings in our fund UFO, Rocket Lab, which is doing launch services in various countries around the world now. And there's other launch companies in Europe like Avio and others that could potentially benefit from those that don't want to just contract with SpaceX at all, or are looking for other redundancies because they don't want to be completely dependent upon one launch provider. So we are seeing some companies have some success in recent months as well, regardless if that's the impetus for them getting contracts or just because there's so much demand out there that one provider can't take on all that demand.
All right, a lot to watch in the space. Andrew Chanin, who is the Program co-founder and CEO, thanks so much for taking the time.
Thank you.
Coming up, everyone, more on Elon Musk, the billionaire amending his lawsuit against OpenAI to include Microsoft. We'll discuss this and what Musk's role in the White House could mean for the tech sector next on Catalyst. Elon Musk's years-long feud with OpenAI and Sam Altman is escalating here. Venture capitalists Reid Hoffman and Microsoft are now defendants in Musk's case against the owner of ChatGPT. Plus, Musk's startup xAI and Sivan Zilis, a former OpenAI board member, have been added to the plaintiffs and added as plaintiffs to the case, and Musk is alleging that OpenAI and its founders conspired to defraud him by putting commercial interests ahead of the public good. With the billionaire headed to an advisory role in the White House next year, what could this mean for Musk's friends and his competitors? We've got Sarah Krebs, the director of Cornell University's Tech Policy Institute, here with us. So if he does get into a very influential role within the new incoming administration, the reboot Trump administration, what could that potentially mean for some very cutting edge technology where Musk is making some severe allegations here?
Yeah, I mean, the lawsuit is interesting in itself, and I think is emblematic of a lot of the complications and complexities of these issues. So in this case, with Microsoft and Elon Musk's concern about antitrust, I found that very interesting that he was adding Microsoft to this lawsuit in the sense that Microsoft is good at a lot of things, but one of the things it's probably best at is in defending against antitrust. It has a lot of experience from that, from the 1990s and early 2000s. But it certainly seems peculiar now, or not surprising, given that OpenAI is worth about $157 billion, that Musk wants to get in on that action. But his role in the White House and his influence, I think, will complicate things considerably in the sense that he has so many different companies, so much influence now with the White House, trying to figure out how that works, thread that needle of conflict of interest versus representing, I think, a real interest within the tech industry of deregulating will be difficult.
Talk to me about the context you just provided on Microsoft. Does their ability to withstand regulatory pressure fundamentally change with Musk so close to the president-elect?
I think that in theory, the courts are independent in this regard, and I think that our system of courts has shown to be fairly kind of independent of what I think we would see in a White House setting. And I do think that this question of antitrust and anti-competitive practices has had a long history, again, kind of interestingly with Microsoft itself. And so one of the things I spent a lot of time reading this lawsuit last night. And so it points a lot to the 70% of the market share, and you know, having a large percentage of market share is not what antitrust is about. Right. It's using that position for anti-competitive practices to harm consumers, predatory pricing. And again, that's interesting because that's something that Microsoft had a lot of experience with in the late 1990s and 2000s. So I think that the attorneys will get involved here in ways that I think are probably fairly independent of the political process. I
mean, does this hinder the rate of innovation when we typically see tech companies that are tied up in legal cases like this and any type of litigation that is making allegations like what Elon Musk is saying here and the core intent of what OpenAI is putting forward and into the market?
Yeah, I think that's a really important case because even if in the end, Microsoft settled in 2002. I think it's fair to say that they were set back for quite a few years, just that they were so tied up in that legal process. On the other hand, you know, OpenAI is showing that it's quite dominant in this space. Of course, that's the reason for this lawsuit in the first place. But you know, there are so many other complexities here as well. One of the big things that came out last week is that AI doesn't seem to be scaling at the rate that was predicted. So there have also been questions about AI bubbles. We may be facing that as well, in which case this might deflate itself through kind of some of these technical limitations.
Yeah, and it's interesting. We're coming up on just about a year after Altman was ousted from OpenAI's board, or in his seat as the founder, given some of his views on turning the company into a for-profit company, which we are, of course, now seeing again, Sarah. I'm curious from your perspective, if some of this from Musk is real when it comes to the actions of OpenAI being anti-competitive, or is this a little bit petty? Because we know that he was involved with OpenAI back in 2018. Is he making a real point here either way?
I think yes and yes. So it's a little bit petty, but it's also a little bit real. And the way in which it's real is that OpenAI did start as a non-profit and a research organization that was funded by Elon Musk. But there were real market pressures. And I think what happened in 2022 with the release of ChatGPT, where this thing just took off, those pressures were real. And then the investment started flowing. And so it seems that created these pressures to shift from a nonprofit to a for-profit entity in ways that, I think one of the reasons why this will be difficult to succeed, his suit will be difficult to succeed, is that he would have to show that there was some kind of nefarious, premeditated plot of some sort, plus this anti-competitive, consumer harming behavior. And I think those two things are difficult to show.
Sarah Krebs, thanks so much for joining us. Really appreciate it.
Thank you.
Coming up in our next hour, we've got wealth dedicated to all of your personal finance needs. Brad Smith, he's going to stick around for his third hour of anchoring today. So stay tuned for that and more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we're going to talk about the market moves that you might want to consider as we get closer to the new year. And 3 things you should know about Nvidia ahead of earnings if you want to sound smarter in front of your friends, family, and coworkers. Plus, the state of the housing market. We'll talk to Realtor.com's chief economist about where you can expect mortgage rates to be in the new year. All that and much more coming up during today's show. First up, let's take a look at some of the market action. We are 90 minutes into the start of trade. Stocks are mixed to begin the week here. Taking a look at the Dow, the S&P 500, and the NASDAQ. The Dow, the lone decliner as of right now. And it's coming off of the worst week in 2 months here. So joining me now, we've got Jeremy Bryan, Gradient Investments Senior Portfolio Manager. Great to have you back on the program with us. If you're taking a look at some stocks with discounted valuations, where are you finding opportunity right now?
Yeah, it's really trying to keep it diversified, if you will. So what we're trying to pay attention to right now is what can grow in a market that maybe starts to go off of the AI generated boom that we've had and now the post-election that is starting to come back down. What stocks can continue to grow? What hasn't participated maybe quite as well as we had anticipated earlier in the year, but still have growth opportunities in the future. So the nice part about that is you can find those in different pockets. So you don't have to concentrate yourself in one particular subsector, one particular region of the economy in order to do that. You want to actually diversify that out and look in different areas to try to get that growth. But there are some opportunities out there for things that, frankly, have had some difficult times over the past few months, but we still see as opportunistic going forward.
Difficult time over the past few months. What areas of the market are those? And do you think that they're poised for a bounce back?
Yeah, I'll start with the consumer side, and the consumer side being a restaurant. A company that we're pretty interested in is Wendy's. From a particular perspective of it's about as cheap as it's been over the last 10 years. Now, the numbers haven't been quite as good. The comp growth has really slowed down here a little bit. But even if you think that starts to stabilize going forward, we're talking about a very high dividend yield stock that is a franchise model, so the margins are good. It's a pretty good model to have going forward for opportunistic, just to kind of continue to block and tackle and getting a multiple that's much cheaper now than it's been.
Okay, and
the other side of that argument. Oh, go ahead. I'm sorry.
No. You were going exactly what I was going to ask.
Yeah, the other side of that would be something like a Coke, right? Which is down over 10% here just in the last month or so. They kind of fit in the same camp of saying, hey, these are kind of steady companies. They're not going to knock your socks off from the growth side, and they're not going to massively accelerate, but they're also not likely to decline aggressively and substantially. So something like a Coke at this level right now is trading at about a relative valuation of about its 10-year lows as well. So both of those areas you can get involved in, get some substantial dividend yield from both of those stocks. And I think a more durable growth rate in the future that'll allow people to come back into this and saying, hey, I may not knock the cover off the ball from this, but I can own this thing through a weather potential storm as well.
A few things that we didn't have on our bingo card coming into the year is probably the successes that we've seen of utilities in that sector and the performance that we've been watching year to date, outpacing the S&P 500 right now. XLU up by about 24%. And then additionally, you think out to energy as well here and some of the fluctuations that we've seen there year to date, but ultimately still looking at returns of about 12.8%. Of course, not keeping pace with the broader average, but that actually has one of your larger plays as well that you're tracking in an energy services company, SLB. Why is that?
Yeah, I'll start with utilities. I think utilities is an area where I would just be a little careful. Because we're starting to hear a lot of the utilities as an AI play and a growth play on that. That is something that we are pretty cautious on here from a perspective of these are heavily regulated entities. It is tough for them to really get through a substantial amount of growth that should substantially change their multiple. These have historically been looked at as more safe plays with dividend yield. That's absolutely fine. That holds. But if you're looking at this as a growth avenue, we're a little more cautious on that. From the SLB side, this is a stock that frankly just hasn't worked very well over the past 6 months. But we think, with energy prices, if they're stable to slightly increasing over time, and especially among the services, if we start to increase production across the globe for whatever reason, SLB will be a big beneficiary of that. And again, you're getting it at a multiple that is an area of valuation that is cheaper than in a very long time, to be completely honest with you, and an area where you could get future growth and a dividend yield that supersedes even an average market cycle. So we just think it's opportunistic to get involved here at these levels.
It's a rare condition this day and age to read any portfolio manager's analysis or notes and not see an Nvidia mention. And stop me if I'm wrong, but I don't think I see any Nvidia mention within your notes here. I mean, what are some of the most sensitive parts of the market to an Nvidia disappointment come later on this week from your assessment?
It's an excellent question. And yes, you're absolutely right. We own Nvidia here, but we are probably underweight relative to the overall, to the market average or the index average, if you will, if you use the S&P 500. So from our side, we do own it. We still think it's valuable over a longer period of time. But I think you hit on it. You nailed it on the head there from a sensitivity perspective and saying, if something happens here, now again, we don't see a massively negative quarter, but if something were to happen, a surprise, not only would Nvidia get hurt, I think you would see the natural semiconductor industry really have some difficulties, because we've seen higher and higher average multiples for some of these AI beneficiary stocks, and these are cyclical businesses. So this could roll over pretty fast and people could get nervous about that again. The other side would be obviously your software components, your natural AI beneficiaries, your Microsofts, your Amazons, your Metas, those kinds of things would probably say, okay, what is happening here? Because they're talking about elevated CapEx, but it's not flowing in Nvidia. Is artificial intelligence in trouble as a result? So that's what we'd have to watch for.
Jeremy Bryan, who's the Gradient Investments Senior Portfolio Manager. Jeremy, good to have you back on here with us. Thanks so much.
Thank you.
Let's do a quick check on Nvidia here. Taking a look at shares of NVDA. They are lower right now by about 1.4%. This coming after a report from The Information highlighting overheating issues with its latest Blackwell AI servers. Now, this comes ahead of Nvidia's big third quarter earnings report Wednesday. And we want to make sure that you're prepared to talk all about the AI darling with your friends, your family, your coworkers as we head into the holiday season. Here with more, we've got Yahoo Finance tech editor Dan Halley. Dan, great to see you here this morning. You're prepared with 3 things that people should know about the company.
Yeah, Brad, let's just go over kind of the basics. First of all, Nvidia was a company that started basically for video games. They were releasing these graphics cards. They say that they're the first ones to release a quote-unquote graphics card years ago. And so they've been in that space forever. But the company started to kind of turn a corner more recently when their investments in AI started to pay off. They were investing in AI for a while on the strength of those cards and their ability to do parallel processing. And because of that, they were able to perform AI tasks far faster than a normal CPU would do. That's the chip that you have that really powers your computer itself or a server itself, the graphics card. Normally, again, that's for video games, but they managed to find out a way where it's helpful for AI, and that's kind of where they are for now. The stock price for the company, by the way, has just rocketed on the AI boom. When ChatGPT came public in 2022, we started seeing more companies investing, and as a result, those companies needed chips to be able to power those kinds of AI applications. And they went to the top dog in that space, and that's Nvidia. And so that's why the stock price has just ripped so far and why its revenue has jumped so high. And then the third thing to keep in mind for this coming earnings is Blackwell. Blackwell is Nvidia's latest and greatest chip. It's starting to be shipped out now, and it really is something that companies are looking at as kind of a game changer as far as performance goes. Their prior Hopper chip is out. It's been out for a while. This is the next generation of that. NVIDIA says it's the most advanced chip ever created. And so this is going to be an important part of the earnings report as to how many units they expect to sell, how many they can deliver, and what the revenue is going to look like on that for the coming fiscal year. So they're going to be reporting that, and analysts are going to have a lot of questions. I know you mentioned the overheating issue that the information had discussed. So they're going to be looking at those kinds of questions and looking to see what Jensen Huang, CEO of Nvidia, has to say.
All right, Dan, thanks so much. A lot to keep tabs on with this name, of course, a bellwether and a poster child for AI. Good to check in with you, Dan. Thanks. Now time for some of today's trending tickers. We're tracking the best and worst performing stocks of the session, and you can too. Check out Yahoo Finance's trending tickers page. I'm joined now by Catalyst co-host Madison Mills for this one. All right, Maddie, let's break down Warner Brothers Discovery. The NBA and Warner Brothers Discovery actually extending their relationship for another 11 years, with the league saying it's resolved all disputes regarding its media partnerships. This comes after the league previously signed new agreements with Disney, NBC Universal, and Amazon to broadcast some games. And TNT Sports will continue to produce Inside the NBA, which will air on ESPN and ABC starting in the 2025-2026 season here. Some big news, especially for the basketball lovers out there, like myself, like your boyfriend, I know, as well.
Big basketball guy.
Yes.
You guys play together often here. It's interesting, though. I mean, I'm thrilled that this story is finally getting put to bed, at least for now. I feel like we've been waiting for the finality of this story for so long, since July, to put a date on it. Warner Brothers suing back in July, saying there was a failure to allow WBD to use their matching rights on a package of live games. Now they've come to this settlement with those three media partners that you mentioned, Brad. This was an expensive situation, though. This cost about $77 billion, according to CNBC, for this package of live games. Now, obviously, for Disney, Comcast, that's going to be a broadcast network deal, and then for Amazon Prime Video, that's going to be just streaming. So there will be different avenues for folks to tune in to these games, whether that be on streaming or via the broadcast network, but certainly an expensive settlement. And this, of course, does officially end Turner Sports' 40-year relationship with the NBA.
Yeah, this is massive. And I'm glad, though, that we'll still be able to see the Inside the NBA crew, of course,
Yes.
the legendary team that they've been able to assemble, and good to see that they'll be able to still take the show out there, of course. A major part for basketball culture as well, so good to see that there's some tie-up that's going to allow that to happen. Next up, though, we got to take a look under the hood with Robinhood here, getting an upgrade to buy at Needham, setting a price target of $40. Analysts citing a potential expansion of the platform's cryptocurrency offerings under a Trump-appointed and crypto-friendly SEC chair. Analysts also additionally noting that with its successful targeting of younger traders and meme-related assets, Robinhood recently notched record-high trading volume of meme coins here. So I don't know what are the favorite meme coins these days. There's so many, but ultimately, I mean, what do we make of this for Robinhood?
Well, it's so interesting, too, that meme coins are viewed as a positive catalyst for stocks these days. That's really telling about how much the meme coin trade has really driven the smart money in the room, right? It's also interesting that Trump is being viewed as such a catalyst for the stock, given that we still don't know Treasury Secretary who's going to take on that spot, who's going to take on the SEC role from Gary Gensler. Will they be as positive to crypto as the street is pricing in to the likes of Needham with this recent note? That's what we were talking to a lot of guests about this morning, Brad, just the idea of the market potentially getting over its skis a bit with betting on Trump being a positive catalyst in terms of picking people who are crypto friendly. We still don't know who Treasury Secretary is, so that's a question moving forward. Also, just taking a look at the Robinhood balance sheet, the stock has soared 315% from its 52-week low, so huge gain there. But monthly active users still down nearly 50% from their high coming out of COVID in 2021. At a low point for the year in their Q3 earnings results, Robinhood had just 11 million monthly active users. They've announced some new products to try and beef that up, but I think that's going to need to grow alongside some of those external factors like the Trump administration's policies.
Absolutely. Great breakdown. Maddie, thanks so much for joining me. Talking some of the trending tickers here this morning. There's also another major trending ticker that we're watching, and here's the story. Spirit Airlines has filed for Chapter 11 bankruptcy after years of losses and a failed merger with JetBlue. So let's talk about what this means for you. Filing for bankruptcy doesn't mean a company stops existing. In fact, the Chapter 11 system is built to allow a company to stay in business while reorganizing its finances. So let's break down what this bankruptcy means for shareholders and customers. First, if you're a shareholder in Spirit, you may be in for a bumpy ride. Spirit says it expects to be delisted from the New York Stock Exchange in the near term and will continue to trade in the over-the-counter or OTC marketplace. Spirit saying in a statement, shares are expected to be canceled and have no value. Typically in Chapter 11 bankruptcies, shareholders are the last priority for payouts here. Banks, suppliers, and even bondholders, they tend to get paid first, meaning that shareholders could lose a lot depending upon how much money they put in. Important to note here, shares are currently trading around $1 today, and shares are down 90% during 2024, leading up to this bankruptcy filing. So lots of value has already been lost. But let's turn now to customers, because what does this mean for them and that side of the operation? Well, in the release, Spirit says it expects to continue operating its business, and guests can continue to book here and fly without interruption and can use all tickets, credits, and loyalty points as normal. Coming up, everyone, we'll get a pulse of the housing market with Realtor.com's chief economist and investment and market insights for retirees. We've got all your personal finance needs covered. Stay tuned. Home builder sentiment improved for a third straight month, according to the National Association of Home Builders. Confidence in the market for newly built single-family homes rose 3 points in November to 46. This is according to NAHB Chairman Carl Harris. Builders are expressing increasing confidence that a GOP sweep in Washington will result in regulatory relief for the industry, leading to more construction. Here with more and reaction, we've got Danielle Hale, who is the chief economist over at Realtor.com. Danielle, great to have you back on the program with us. Is it as simple as that, or is there something else that's also going to be to play out within this mix? And what are the anticipation for buyers as well on the other side of the builder's calculus?
Thanks for having me, Brad. Yeah, I think what we've seen recently is that the new segment of the homes for sale market has done relatively well compared to the existing segment. It's been a bit more sluggish as a lot of homeowners are locked into low rate mortgages. And so builders have done a good job, but we've got a big deficit of homes that we haven't built over the last decade. So Realtor.com estimates suggest we're between 2.5 and 7 million homes short over the last decade. So we need to do a lot more building. Builders have routinely cited things like regulation, land shortages, difficulty finding labor as obstacles for building more homes. So maybe if the administration comes in, especially with the benefit of a Congress that is of the same party, we might see a bit of a shakeup and some of these things that have been roadblocks for builders start to move away.
And so with that in mind, are the costs associated with owning a home, do we see that in the high tenor and of course the affordability, do we see that crisis easing a bit?
Yeah, it has been very expensive to buy a home. Interestingly, builders have been able to offer incentives, in some cases reducing the price, in some cases doing things like mortgage rate buy downs, which has in fact softened new home prices, even as existing home prices have continued to go up. So it is helping a bit, but underlying all of this, mortgage rates continue to be very close to recent highs. They're very close to 7% again, which does create a headwind for home buyers and also for home sellers. So if we look at the existing side of the market, the higher rates go up, the more locked in people are. The lower rates come down, it's more affordable for buyers and for sellers to consider making a trade instead of staying in their existing home.
Interesting. And what do you think that rate needs to come down to for us to see a wave of demand of potential sellers listing their homes and people who are trying to refinance for that to become a reality?
As we got closer to 6%, we did start to see a little bit more life in the new listings coming to market. Actually, the existing home sales data that we're going to get later this week will also reflect that time period of September when rates were very close to 6%. So we might see a bit of a pickup. We saw a big pickup in pending home sales in the recent data. So I think we'll see, but we do know that 84% of homeowners that have a mortgage right now are locked in at a rate under 6%. So we're going to have to certainly fall below 6% to meaningfully unlock a lot of those homeowners.
Danielle, while we have you, I mean, I'm glad that we're past the election cycle so that we're not arguing about politics as much, and maybe we just go back to arguing about homeowners associations, because this has been remarkable to see the number of homeowners associations and the growth rate of HOAs as well. Why do you think that is?
Yeah, we took a look at listing data and we saw that roughly 48% of homes in October that were for sale had a HOA fee associated with it. And that's up from 40% just 5 years ago. We know that with affordability as stretched as it is, we're seeing more smaller homes. And that is often things like townhouses or condos that are on the market. They are more likely to have homeowners association fees. So that's probably a big part of why we're seeing this increase in those homeowners association fees on the market.
And what type of impact does that also have on just home ownership, as that's something that then potential buyers need to factor into their regular costs?
Yes, absolutely. So, I mean, they still generally pale in comparison to property taxes and other costs. But if you're thinking about buying a home that's in a homeowners association or in a condo, you will want to consider those fees. When you make the purchase, you will often be handed homeowners association or condos association documents to review. And it's worth taking a look at how the financial position of that homeowners association is to make sure that you're considering those other costs that you will likely have to bear in the long run.
Danielle Hale, who is the Realtor.com chief economist, good friend of the show. Thanks so much for taking some time here with us today. Appreciate it.
Thanks for having me.
Certainly. Switching gears here, let's do a quick check of the markets as we are taking a look at the Dow Jones Industrial Average. It's flipped positive. It's up right now, fractionally as it may be, 0.07% in the green. And the S&P 500, that's added on to some gains that we started off the day with. It's up by about 0.5%. The NASDAQ Composite, that too, adding on to gains. It's up by about 0.9% right now. We're just under 2 minutes into the start of trade. Let's talk about some money moves that you should be making if you're nearing or in retirement. Here with more, we've got Anthony Siccaro, who is the president of Providence Financial and Insurance Services here. Great to have you back on with us. So you're taking a look at some of the post-election rally, and there was a bit of a slip up towards the end of last week. You've got a lot of potential retirees or people who are trying to figure out, okay, what does this mean in terms of my money management right now? Should I be locking in gains or should I be adding into positions? What's your analysis?
Well, it's no question that the economy has continued to do well, do even better under the Trump election at this point. GDP is in a good place. Inflation's coming down. The Federal Reserve has already lowered rates. And of course, those are all just tailwinds for continued growth through the rest of 2024 and even in 2025. The challenge, though, that I'm worried about is that I don't want retirees to get over their skis. We're in the honeymoon phase. We're in a euphoria right now. And a lot of times when we get into this euphoria and crypto's going up and the stock market's rallying, and it's very easy to think, well, I should be in. And then let's go take everything and get in the market. The challenge is that the market is still a dangerous place to be. And it can turn and bite you at any point in time. And so the reality is, if you get out over your skis and we have another major market crash, like we've had 2 crashes greater than 50% over the last 25 years, that could happen again. And I don't want you thinking, or retirees thinking, that the market is a safe haven. It's not, but a lot of people start thinking that. So you've got to have a plan where you can stick with your risk tolerance. You have to know what your risk tolerance is. And make sure that you don't make decisions to violate that plan just because everyone else is in a honeymoon phase. That'd be a mistake.
So the markets have, and as they've been in this honeymoon phase with the run up and kind of the sense of euphoria that is certainly permeated, and we see that in some of the new recent highs and some of the new climbs higher as well. But more largely, once we get into the next administration, there have been some calls from economists who are concerned about some of the hard pivots, the big cuts that have been talked about, and the economic impact as well of everything from cutting $2 trillion from the budget and finding areas to make cuts, all the way to mass deportations. How would that pass through to the economy from your sense, and then thus be evaluated by the market?
Yeah, so we have to remember that all the rhetoric leading up to an election and then post-election, it doesn't mean that that's all going to become policy. Now, if we wind up having a sweep in Congress and the Senate and so on, then yeah, there's going to be a lot more flexibility. The other concern that I have, just a little concern, is that this is Trump's last year or his last 4 years in office. So it allows him to be a little bit unfiltered, a little more unfiltered than maybe he is, and maybe to push through policies on a little harder path than maybe he was before. And there are some negatives. You mentioned immigration. There are a lot of highly skilled, highly paid immigrants that are in this country as well too. We've had a labor shortage in this country for a long time, and if we start mass deportations, that labor shortage could worsen and increase the cost of wages, which then it gets passed on to the consumer through inflation. You got to raise the price of your goods and services if you're going to pay your employees more, and you might have to pay your employees more if there are less employees because of the deportation. The tariffs is another issue. Trump talks about the fact that the tax cuts is going to offset the tariffs, but is that really true? Ultimately, if you charge more for goods and services coming in, that's going to have to be passed on to the consumer and could wind up resulting in inflation as well. So it's not all rosy. And you're right, there's definitely going to be some bumps in the road once we find out what his actual plans are and what he can actually get passed through. It's not all rosy. We're still in the honeymoon phase, but you and I both know that after the honeymoon phase comes the marriage, and that's a lot of work.
Well, there's a lot of retirees out there that may already have been married for decades at this juncture, and they're trying to figure out, okay, how do we make sure that we're just riding off into the sunset on the gains that we're trying to lock in? What is, with everything that we've laid out, your investment strategy for retirees?
So I like to focus on investing for income. Most retirees need to get income out of their portfolio. And if you're invested in stocks and mutual funds, primarily growth-related investments, the only way to get 3 or 4 or 5% a year out of your portfolio is to start selling shares. And if you sell shares, then eventually you have the worry of running out of shares, running out of principal before you run out of life. And that's what we don't want to happen. But if you invest for income in the form of interest and dividends, you can spend your interest and dividends without ever selling a single share. And that means that you don't ever have to worry about your money running out. It's the difference between eating the chicken or eating the eggs. If you're cannibalizing your principal and you're selling shares to get your income, you're eating the chickens. But if you're living off your dividends and interest, you're eating the eggs, and you never have to worry about those eggs continuing to come in. So I like to focus on that for people that are retired, because it makes your retirement more secure. You know you have the income. You can invest in things that you can count on the income. You can never count on growth. If you have a portfolio, we don't know what that portfolio is going to be worth in 2 years or 5 years or 10 years. But if you have dividends and interest, you can count on it. And there's a lot of retirees out there that could afford to take some chips off the table. They've done really well over the last decade and a half, and now they're going to retire. A major crash would kill them. Living off of interest and dividends would give them a much greater chance of a secure future. So that's the focus that we go with retirees.
Anthony, I knew I could always count on you for either a really good metaphor or a really good analogy. You delivered just that. Anthony Siccaro, who is the president of Providence Financial and Insurance Services. Thanks for taking the time.
Thank you, Brad.
Coming up, everyone, your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We're 2 hours into the trading day, and it's time for Yahoo Finance's market update. Stocks edging higher, with the Dow the last to edge into the green, but still near the flat line. The Nasdaq, though, the strongest gainer, thanks to Tesla getting a boost on reports of self-driving car regulation being a priority for the incoming Trump administration. Well, here are 3 trending headlines that you need to know. First, Bloom Energy's deal with American Electric Power sent the stock soaring on hopes that their fuel cells can be a workaround for the AI-driven data center demand. The fuel cells convert fuel to electricity without being plugged into the electric grid and can power data centers consistently even if the transmission grid gets congested. And smart TV and streaming company Roku getting an upgrade from Baird to outperform from neutral, as investors may be overlooking, quote, meaningful changes in the business and the attractive long-term opportunity. Increased competition in the streaming space and cost-conscious consumers have weighed on the stock year to date, down more than 20% so far. Plus, McDonald's is investing more than $100 million to bring back customers after an E. coli outbreak traced back to slivered onions in its quarter pounders hurt foot traffic and sales. $65 million will go to the worst hit franchises. The rest will go to marketing, including a 10 McNugget for $1 deal via the app, according to an internal email viewed by CNN. And that's your Yahoo Finance Market Update to keep you on track with the news you need to know to make smart decisions about your investments. More wealth when we return.
There's less than a month left of open enrollment if you want your coverage to start January 1st. And when it comes to choosing what benefits to sign up for, the latest data from ADP shows that age plays a major role. Joining us now, we've got Tina Wang, who's ADP's Vice President of HR. Great to have you here on the screen with us on the show. All right, so what are the benefits that all generations should agree on, Tina?
So one of the things we definitely see in our employee pulse survey that ADP does consists about 1,700 responses from either business owners or HR decision makers. And part of that is for traditional benefits, it is medical, dental, and vision. So those three definitely come into play in terms of, regardless, I'll say, of generation, that is most desired in that aspect.
So with all of this in mind, how have you seen this kind of differ among generations, and what generations have looked for as they are signing up during this open enrollment period, and what they're prioritizing within their coverages?
So I would say those three traditional for sure come up, but the other non-traditional benefits that come into play are around mental health, learning and development, and paid leave. And in each generation, they may be weighted slightly differently in terms of, I'll say, what's most desired, but they're all showing up as things that they definitely want.
And so all of these things in mind, it seems like, especially among the new cohort of workers that are just getting into the labor force and participating, they're also looking for vastly different types of benefits than their generations prior. What are some of the main differences that you've seen there?
So we see a little bit of the mental health benefits, whether it's providing certain resources for them to focus on from a mental health perspective. The learning and development options in terms of growing their career path within an organization. And I probably would add the educational, I'll say the tuition reimbursement options, as well as they learn to continue to, I'll say, develop in their careers.
This one's a little bit more self-centered for my millennial friends out there, mid-career millennials, maybe starting a family. What's important to them?
So three things that are showing up are paid family leave, child and elder care, as well as life insurance. And I'll just share quickly, like for me, I'm in that selfish zone as well. I'm actually in the process of having a family member that just suffered from a stroke. So that elder care benefit is definitely something that is important in terms of how we navigate that.
Absolutely. And finally here, we got to think about the boomers. Can't leave them out of this conversation. What benefits are they looking for?
So definitely focusing a little bit more on their retirement benefits. So they're a little bit less on the benefit selections as much as how do they prepare, in terms of moving out of the workforce at some point in time.
How can employers also educate themselves on what new offerings they should be bringing to their employees, as so many of the new services that may get prioritized by different generations are thought of and asked for by some of the employees? How can employers educate themselves as well?
Yeah, so look, I think it's really important to make sure you partner and have partnerships with either, payroll, your insurance agent, your retirement partners. They really understand what is out there and what's available for an organization to think about, like what they can afford and what they can provide for their employees. In addition, I would also say that, asking the employees, so if you are part of an organization, whether you're a small business or a large organization, really having those conversations with your employees to understand, hey, what is it that you're interested in? What else is out there? And in addition, how do we educate? And because open enrollment is a one-time, event, and it shouldn't be. Like that ongoing conversation around education of benefits that are relevant, that I'll say employees may not think are relevant, but will be relevant at some point in time because something may happen. And again, I'll just share a quick story for me. Like I ended up in, not signing up for long-term insurance. And it turns out I ended up in a car accident, and I actually could have really benefited in terms of understanding what some of those things may happen.
Wow, absolutely. Well, glad to see that you're doing well. Glad you could join us here today. Just lastly, before we let you go, Tina, this is a common mistake. People forgetting about Gen X out there, and I don't want the smoke from Gen X on Twitter or Facebook or whatever platforms they're using. They're probably microblogging somewhere. But all these things considered, what is Gen X looking for and prioritizing?
So I probably would tell you that it's probably looking a little bit more at the life stage, like a Gen X and I'll say the millennials are probably in that mid-career stage, right? So things like the paid family leave, the childcare, the life insurance for non-traditional benefits do come into play.
All right, Tina, great to have you here. Tina Wang, who is ADP's Vice President of HR. Thanks so much for hopping on with us.
Thank you, Brad.
Certainly. We're just a week out, roughly, from one of the biggest shopping days of the year. Black Friday and then Cyber Monday. Consumers are expected to spend an average $1,069 on holiday purchases in 2024. And guess what? That's up 14% from last year, according to Retail Me Not. This comes as credit card debt hit a record $1.17 trillion in the third quarter of 2024, according to the New York Fed. So, how do you avoid adding more debt during the holidays. My next guest is David Peters. He is the founder of Peters Professional Education and of Peters Tax Preparation and Consulting. Good to have you here. All right, you hear a figure like $1.17 trillion, and you got a lot of consumers out there trying to figure out how they can spend, but spend smartly and also pay down some debt. Perhaps let's start with setting up smart habits going into this season. How can people make sure that they are setting a budget, checking it twice, sticking to it, and ultimately kind of rolling out some people who might have been naughty on that list?
Yeah, so I mean, I think that you hit the nail on the head. I mean, I think that the big thing to really sort of get across immediately is really having a good budget and sticking to it. And there are, lots of ways to keep track of a budget, but in my opinion, utilizing a spreadsheet and creating that spreadsheet and keeping track of that on a daily basis as you're going out shopping during that busy season, I think is the way to go. Another thing is just really making sure that we use cash whenever that's possible. We see that cash going out of our wallet, and that helps us stay within budget, stays because we see that money disappearing.
Certainly. And so one of the other tips that you had on there really looks towards the rewards part of your balances as well. How can you deploy rewards during this season?
Well, there are a lot of credit cards that offer cashback rewards, and those rewards have gotten more generous over time. And so if you do have a card that does offer cashback rewards, as soon as the statement cycle ends, normally those rewards are available. And so if they're available, take those as a statement credit so that you can bring that balance down a little bit as you are spending.
If you already have credit card debt, how do you pay it off ahead of the holidays?
Well, I think that the main thing is that you need to make a conscious effort to set aside money to pay it off. So set aside a part of your paycheck to service that debt, to make sure that you are paying that down on a regular basis so that we can avoid interest and we don't necessarily dig ourselves into a deeper hole.
With regard to the consumer mindset, we've heard a lot about the resilient consumer. How do you anticipate that would show up within an environment that we just laid out, where there is this record high level of debt that is being carried, and especially knowing the propensity to just tap, swipe, use a credit card during a season like this?
I think that it's really easy to sort of fall into bad habits, and that is exactly what you're talking about. You're talking about that, we always spend this during the holiday season. I think that we have to realize that we have had a period, especially over the last couple of years, of elevated prices, and we just need to pay attention more this year, maybe than we have in the past, about how much things cost. And we need to be more price conscious, and we need to be looking at what we're doing. The only way that we're going to turn things around and the way that credit card debt doesn't grow and get kind of out of control is by staying within our budget.
Are there ways that you can spend and budget that are actually tax beneficial once you get into kind of looking at your filings that you'll be needing to prepare at the end of this year for next tax season?
Well, I mean, so there are certain things, certain types of spending that are deductible. Charitable contributions may be one that may come up when, in order to get that, though, you would actually have to spend the money towards the charity in order to take advantage of that tax deduction. So there certainly are some ways to do that, primarily in the charitable contribution area.
And just lastly, while we've got you, David, the pros and cons, of course, have been explored for buy now, pay later by many consumers, and many consumers might lean into this if they're not able to just take the cash out and pay for something, or if they do need to finance over time. What are the pros and cons that you've seen among your clients and especially within your own consulting?
Yeah, so I mean, buy now, pay later. I mean, there's definitely been a rise in popularity of those products. The problem is that with buy now, pay later is that people know about the buy now part, but they forget about the pay later part, where that we still are on the hook for that debt going forward. And so I do think that those strategies can work, but we just got to remember that we are going to have to pay that debt down. And And so we need to make room to pay for that debt in our budget and in our paycheck. I think as long as we do that, and we are paying those balances off, then I think then that can work just fine.
David Peters, Peters Tax Preparation and Consulting founder. Thanks so much for taking the time here with us, David.
Thank you for having me.
Coming up, everyone, what the crypto industry could look like under the incoming Trump administration. That's next on Wealth.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
This week on Yahoo Finance's Financial Freestyle, host Ross Mack sits down with Waymo Abbey, who is the co-founder of Isuzu, a fintech company that focuses on rent reporting and credit building solutions. In this clip, Abbey discusses wanting to continue to grow his business. Take a listen.
There are only 12 black unicorns in the world. Wow. So unicorn companies, a company valued at $1 billion or above, and we're sort of lucky to be in that ecosystem and that sort of class. But I don't get carried away, and I tell my colleagues at Isuzu day in, day out that a unicorn is a unicorn, but if you cannot try as much as possible to go to the next level, outperform as a business, your performance, right, is the premium you pay to earn the right to be a unicorn.
New episodes of Financial Freestyle air Mondays, 12 p.m. Eastern Time. You can catch them on Yahoo Finance or wherever you get your podcasts. Bitcoin hovering right around 91,000 today, rebounding after falling a bit over the weekend. Here with more, we've got Yahoo Finance's Josh Lipton with a closer look at the digital currency's performance and what we can expect in the months ahead, as all eyes are on the Trump administration now.
That is correct, Brad. In the run-up to the election, remember, strategists emphasized which sectors they thought could benefit from a Trump win, including financials, traditional energy, and yes, crypto, and for good reason. After all, Trump positioned himself as a friend of crypto, making a range of pledges like appointing a crypto presidential advisory council, establishing a Bitcoin strategic reserve, and firing SEC Chair Gary Gensler, viewed as an industry antagonist. And remember, it wasn't just Trump. Ohio elected pro-crypto candidate Bernie Moreno to the Senate as well. Yahoo Finance spoke with leaders in the industry to see what they think Trump should now emphasize. They quickly called out that Bitcoin strategic reserve as a priority.
And so I think when it comes to the United States, yes, holding the Bitcoin that we already have is kind of a no-brainer, but buying it is also very, very important. There is a global race for Bitcoin going on right now. And whether you are a local, state, or federal government official, you should be figuring out how to get as much Bitcoin onto the balance sheet as possible. This is not like gold where we can just go dig up more of it out of the ground. This is not like other assets that can be created out of thin air. There's only 21 million. And on the off chance that Bitcoin ends up actually fulfilling the promise of Bitcoin, we're going to want to hold as much of it as possible.
So will those, in fact, be Trump's priorities? Now we wait and see. But investors, they aren't waiting around. The price action in Bitcoin has been headline making. There has been a lot of excitement following Trump's victory. It started making record highs shortly after that win, now jumping around 30% since the election on November 5th. So how much room is there still left to run here? Well, the team at Bespoke Investment Group says it looks very overbought here. Now, usually you would expect to then see a reversion to the mean, but in the case of Bitcoin, strength often begets strength, they say. In other words, its strongest returns have actually often followed periods when it traded at its most overbought levels. Brad, back to you.
You know, it's remarkable, especially in the reserve front, because the United States, in terms of government entities, already owns the most Bitcoin as of right now. So adding on to its strategic reserve would be a major play. And there also might be some geopolitical considerations to that too, as any country around the world tries to figure out what it needs to stockpile in its own cryptocurrency holdings. But the United States holding somewhere in excess of about 208,000, according to BitcoinTreasuries.net right now.
Yeah, whether you just hold or whether you add to that, that'll be a big issue. Also, changing personnel. I mean, Trump made some big announcement, including no phantom SEC Chair Gensler. So what could shifting personnel mean as well? Will be something everybody's going to be watching.
Great breakdown, as always. Josh Lipton joining us here. You can catch Josh later on for Market Domination and the OT. That's it for Wealth. I'm Brad Smith. Thank you so much for watching. Stay tuned for the aforementioned Market Domination with Julie Hyman and Josh Lipton coming up at 3 p.m. Eastern Time.